Okay, good morning, everyone, and welcome to day 3 of our marathon session, where we have entirely discussed to do a mock paper. Uh, but while doing this mock paper, I'm gonna go back to theory. I'm gonna cover some theory as well, so that you are comfortable in both the theory and how to approach exams. Yeah, superb. Uh, it's been wonderful connecting with you. Uh, we've come a long way, and most likely, I'm trying to extend this session for tomorrow as well. I'm trying to see if I can extend it for tomorrow as well. I will let you know if I'm extending by the end of today. Okay. Right. Already we've been looking at some questions. Correct. We've done about 4 to 5 questions already. And now, yes, there we are. We are getting back to some theory. That is in terms of section A and section B questions. Right. Let's start. So if you take your FR paper, as you may know, there are 3 sections: section A, section B, and section C. So last 2 days, my primary focus was on section C. I've been covered section C questions, but today we are going back to looking at section A and section B. So that's how your section A and section B will look like in the exam, but on our platform. But we have our platform, so it will look the question should be the same, but the platform will look a bit different. So what I would advise you to do is, I would advise you to make sure that you go through the platform and start working on questions on the platform. Section C gives us 40 marks in the exam, and we have covered as much as possible questions. But section A and B gives us 60 marks in the exam, and students do get confused. Students think that this is MCQs, this is just, drag and drop, this is just, multiple response areas. Okay, there can be multiple response, MCQs, drag and drop, fill in the blanks. The examiner can come up with different ways to get you answer. Students think because this is multiple choice, or this is just going to be easy, and they do not spend enough time. You got to make sure that you don't take this easy. It's very crucial that you give the time that is required. You get 2 marks for a question. So basically you have to spend about 2 minutes. Yes, you spend about 1.5, 1.8 minutes. But some questions you can spend less than a minute, where the answer is direct. Okay, brilliant. Let's get going. Which of the following items does not represent the correct accounting treatment in accordance with IFRS 15, revenue from contracts with customers? Which of the following items does not represent the correct accounting treatment in accordance with IFRS 15, revenue from contracts with customers? Number 1, treating a sale and repurchase. Okay, you have sold and then you have repurchased. Okay, sale and repurchase transactions we have already looked into. As a loan rather than a sale if control over the goods has not passed to the buyer, where a sale has a significant financing component recognizing the initial sale at the present value. When a package of goods are sold together at a discount, applying the discount to all parts if none are ever sold separately at a discount. Recognizing no revenue in relation to a 3-year service contract until the service is completed at the end of the 3rd year. Which of the following items does not represent the correct accounting treatment in accordance with IFRS 15, revenue from contracts with customers? So I've been getting messages from students asking me, okay, at this point in time, Zian, what is my best way to pass this exam successfully? Okay, today you will see what I am actually looking at. Okay, superb. Now the best way is, guys, you don't have enough time. You don't have enough time for you to go and do actually you do have. If you can spend a lot of time, today is the 13th of August, 13th or 14th of August, you have about another 20 days for the exams. You do have enough time to go and work around the study hub and Kaplan text if you really can push yourself for about 8 to 9 hours a day. But if you are looking at a brief going through the articles, if you're going to briefly going through the standards and getting an idea and then trying to work around questions, past papers, my chart notes is the perfect solution for you. So coming back, IFRS 15. IFRS 15 is a major area of your syllabus. We know IFRS 15. IFRS 15 speaks about revenue, how to recognize revenue. IFRS 15 gives us five particular steps, 5 steps to recognize revenue. Okay, so you have to make sure that 5 steps are completed to recognize revenue in terms of IFRS 5. Identifying a contract, identifying performance obligation, allocate the transaction price to the performance obligation, number one, identify the contract, correct. Number 2, quick, where are you missing? Number 1, identify the contract. Number 2, identify separate performance obligation within the contract. Number 3, determine the transaction price of the contract. A contract can have more than one performance obligation. A performance obligation means what? Promises. There can be multiple performance obligation within a contract. Allocate the transaction price to the performance obligation. If you have 2 or 3 performance obligation, allocate it. Number 5, recognize revenue when or as a performance obligation is satisfied. When or as a performance obligation is satisfied. My dear, you got to make sure that you know this. Okay, you got to make sure that you know all these steps. Okay, there are 5 steps to recognize revenue, and you got to make sure that all 5 steps are ticked before recognizing the revenue. Superb. Now, performance obligation. Now, guys, when you take performance obligations are promises. These promises can be completed at a point in time, or it can be completed over a period of time. So if it is satisfied at a point in time, you recognize revenue at that point itself. Are we clear? But in the exam, we can have specific scenarios like agency sale. Now, someone is there in terms of making the sale, but there is a middleman. Recognize commission only in revenue. Okay, in that case, you have to recognize commission only in revenue. So the commission percentage, whatever it is, you can recognize only in revenue. Cost of sales will be entirely removed because you are a middleman. Number 1. Number 2, sale or return. If control over the goods does not pass the buyer does not have the control over the goods, do not record any revenue. Sale and repurchase. If the control of the goods does not pass to the buyer, do not record any revenue. Treat proceeds as a loan and charge interest to the date of repurchase. Very important. Okay. If obligation is settled over time, if your obligation is settled over time, then number 1, record revenue and expenses based on the progress. Number 2, for loss-making contracts, which we know, immediately show the loss. If progress is unknown, you do not know the progress, recognize revenue to the level of recoverable cost. How much of cost you can recover. In the statement of financial position, record receivable if revenue exceeds the amount received. Record work in progress if cash spent exceeds the cost of sales. Record a liability, show a liability if cash received exceeds revenue. Record a provision if the contract is loss making. We've done questions like that. Now, basically, if I have to summarize IFRS 15, that's it. Now we know, okay, fine, this is my theory. Okay, now I know, okay, there are 5 steps to recognize revenue. I know there are 5 steps to recognize revenue. And I know when recognizing revenue, I have to take into account sale or return, agency sale, sale or repurchase. These are primarily tested areas, guys. You need to make sure that you know it. And if it's a construction contract, you should know the steps that I've given you. I've given you the steps, no, expected outcome, stage of completion, revenue recognition, cost recognition. You have to put the T accounts. If it's progress bidding, money is coming in. you need to be able to do that. Okay, students who are new, who have not followed classes with me, my recordings will be there. In the recordings, you can check how to do the construction costing within about 4 steps. I'll tell you how to do it. Done and dusted. Let's go back now. Okay. Which of the following items does not represent the correct accounting treatment in accordance with IFRS 15 revenue from contracts with customers? Treating a sale and repurchase as a loan rather than a sale if control over the goods has not passed to the buyer. Control over the goods is not passed to the buyer, meaning it is not a sale, but you have taken money. If you have taken money, they are treating it as a sale rather, a loan rather than a sale. Accounting treatment, correct or incorrect? Correct, no problem. Where a sale agreement has a significant financing component, there's a big financing component, recognize the initial sale at the present value. Yes or no? Correct. When a package of goods are sold together at a discount, you have a package of goods, but it's sold, the package itself is sold at a discount. Applying the discount to everything within the package because you're not selling it separately. Correct or not correct? Correct. Recognize no revenue in relation to a 3-year contract until the service is complete at the end of the 3rd year. It's a 3-year contract, but you're recognizing revenue only the 3rd year. Standard says recognize revenue over a period. Correct or incorrect? Incorrect. Answer D. Are we clear? Super. In what order should the assets in a cash generating unit be impaired? Okay, what is the accounting standard? IAS 36. Okay, let's go to IAS 36. Okay, what does IAS 36 talk about? IAS 36 speaks about impairment of assets. Okay, what is impairment? Impairment means what? Impairment means loss. Impairment means what? Impairment means loss. Impairment of assets means what? Impairment of assets means loss in value of an asset. Let me quickly connect my there you go. Impairment. Impairment of assets. Okay, what is impairment? Impairment, the word impairment means loss. Impairment of assets means loss in value of an asset. So as you have assets, your assets can get damaged. Your assets, cash outflows, the benefit that you get from an asset can come down. You understand, the market value can drop. There can be technological problems. So for all this, if the asset value comes down, you have to account for impairment. So to be in line with prudence. So impairment is about to be in line with prudence. So IAS 36 impairment of assets is intended to avoid the possibility that a non-current asset, tangible or intangible, are carried excessive amounts in the statement of financial position. Meaning the value is higher than what we can recover. So basically the standard gives us guidelines. The standard gives us guidelines to make sure that we calculate impairment. Impairment is calculated by comparing your net book value with your recoverable cost. Recoverable value. Your recoverable value will be the higher of value in use, and NRV. Value in use and NRV. Correct? So value in use and NRV. So you will have to get your value in use and NRV, and you will compare and you'll pick the higher value. So indication of impairment. When can you have impairment? You can have impairment, number one, when the company, when the asset is giving you losses, there's operating losses. Technological advancements where your technology is not that too great, and there is obsolescence or physical damage to the asset. Impairment losses are charged to the P&L, we know that, except to the extent that they reverse a previously recognized gain on revaluation. If there's any previously recognized impairment that you need to reverse it and it is charged to the revaluation, you can go and reverse it, no problem. In which case that part will go to the revaluation reserve. Anything extra will go to the P&L. Summary of accounting: debit impairment, credit non-current asset. Unless previously revalued, if you have previously revalued, what will you do? You will debit your surplus if there is a revaluation surplus. If there is anything extra, you will take it to impairment and credit your non-current asset. Cash generating unit. Cash generating unit means smallest group of identifiable assets that can generate cash inflows. CGU. Now, when you take a CGU, an impairment loss on CGU occurs when revenue stream is damaged. Allocation of impairment loss with the following write down rules. Number one, goodwill allocated to CGU, remaining assets on a pro rata basis. But before that, if there is any specific impairment on an asset, you will have to allocate that also. So if there is any specific loss will also be allocated. Are we clear? Understood? Okay. That's a quick summary of impairment. In what order should the assets in cash generating unit be impaired? A, B, C, D. Answer. Any obviously impaired asset, purchase goodwill, then all other assets on a pro rata basis. B says purchase goodwill, all other assets on a pro rata basis, then any obviously impaired asset. That's out. That's out. Just because you see goodwill first, you immediately put goodwill first. See, you lose your 2 marks in the exam. No, any obviously impaired asset, then purchase goodwill, and then all other assets on a pro rata basis. Answer option A. That's the right one to go. Just because you see goodwill, you immediately go and put it, and then you lose your marks. You have to be very, very, very careful. You have to be very, very, very careful because these can be confused. Okay. Which of the following conditions must be met in order to capitalize borrowing cost per IAS 23? Now, IAS 23 says, IAS 23 gives us guidelines in terms of borrowing cost. Now, borrowing cost, if you're going to borrow to construct an asset for a substantial time period, you can capitalize the borrowing cost because IAS 16 says assets are recognized at cost. Cost means all expenses incurred to bring an asset to its intended use. Therefore, borrowing cost is incurred to bring an asset to its intended use. Because borrowing cost is incurred to bring an asset to its intended use, it can be capitalized. It can be capitalized until the construction is done. We know that. Okay, so IAS 23 borrowing cost deals with the question of whether finance cost incurred in the construction of a building can be capitalized or not. Borrowing cost must be capitalized as a part of the cost of the asset if that asset is one which necessarily takes a substantial time period to get ready. That is more than 1 year for its intended use. That is, it becomes a qualifying asset. If you have to commence capitalization of borrowing cost, then the expenditure has to be incurred, borrowing has to be incurred, work should be commenced, capitalization should be stopped when the asset is ready for use or if the construction is suspended. So these criteria should be met. Superb. Which of the following conditions must be met in order to capitalize borrowing cost? Expenditure of the asset is being incurred, yes or no? The loan to finance the construction of the asset has been taken out, yes or no? Borrowing costs are being incurred, yes or no? Activities necessary to prepare the asset for its intended use or sale are in progress. If that's the case, what is the answer? You have the answer here on screen. What is it? It's all of them. Brilliant. It's all of them. Everything has to be recognized. Superb. Proggo purchased an asset on 1st of January 2017 at a cost of 90,000. You're purchasing an asset at a cost of 90,000. Prog received a grant. Okay, you're receiving a grant, a government grant, IAS 20, accounting for government grants and disclosure of government assistance. Government grant can either be towards acquiring a fixed asset. It can be a capital grant or it can be a revenue grant. If it is a capital grant, you can set off against the asset. If it is a revenue grant, you can take it as other income, or you can set off against the expenses. The expenses can be a past expense, future expense, current expense, no problem at all. Meaning you are receiving some funds. You are receiving some funds to help you run the business from the government. So here, Propco purchased an asset on 1st of January 2017 at a cost of 90,000. Superb. Frog received a grant in relation to the cost of this asset of 15,000. It has decided to write off the grant income against the cost of the non-current asset. Okay, it's setting off against the non-current asset. The asset has a useful economic life of 9 years. Okay, let's quickly go refresh our knowledge in terms of IAS 20. IAS 20, accounting for government grants and disclosure of government assistance, deals with the grants which are provided by government in respect of capital or revenue expenditure. Revenue grants. A government contribution towards the cost of wages, for example, can either be presented as a credit in the statement of profit or loss or is deducted from a related expense. We know that. If it is a capital grant, government contribution towards the cost of a new piece of a machinery. Now what we can do, we have a presentation choice. Net grant of the cost of the asset and depreciate reduced amount. Depreciate reduced amount after you set off. Capitalize or depreciate the asset as normal. Treat the grant as deferred income over the useful life. Release the grant income to statement of P&L over the useful life. Applies the matching concept to the grant. Are we clear? Are we clear? Super. Let's go back. Here, what are they doing? They are setting it off. They are setting it off. Because they are setting it off, how are you going to account for it? Because they are setting it off, how are you going to account for it? You're going to reduce the value and then you're going to calculate the carrying amount. Okay. Now, Frogco purchased an asset on 1st of January. Your year end is 31st December. So, your asset cost will be 90,000. Your asset cost will be 90,000. You are receiving a grant. The grant value is going to be 15,000. Meaning your net cost of the asset will be 75,000. Your net cost of the asset is 75,000. Correct. And they are saying the asset has a useful economic life of 9 years. So if you have an economic life of 9 years, now they want to know the carrying amount. First year gone. So you have your cost 75,000 minus depreciation. 75,000 over 9 gives you how much, my dear? 8,000? 333. 8333. 75,000 minus 8333 gives you, obviously I can take 66,667. Answer D. Are we clear? Are we clear? Come on, it can't get this difficult. I mean, this easy. It's easy. Easy as that. Don't come and tell me that you failed this paper. Please don't come and tell me that you failed this paper. Don't come and tell me you scored 50 or 60 in this paper. Okay. Let's go. Right. What is the diluted earnings per share figure to be disclosed in CE's financial statements for the year ended 30th September 2015? Okay, we know IAS 33 earnings per share gives us guidelines on diluted EPS. Diluted EPS means we are trying to see if there are any potential convertibles or potential shares that can be converted. What is the impact on our EPS? How will our EPS change? So we are giving a warning to our shareholders. Hey, look, because of this, our EPS can change. That is the purpose of diluted EPS. So here they say, Coralco has a net profit for the year ended 30th September 2015 of 10,500,000. Okay, our net profit is 10,500,000. But if you are talking about a diluted EPS can affect our profits. Because if we are going to dilute it, if there are any convertibles, the convertibles can have an impact on our interest. Convertibles can have an impact on our interest plus our taxes. So, Coral has 6 million shares in issue for many years. On 1st October 2014, Coralco issued a 3 million convertible bond. A 3 million convertible bond was issued. The liability element was initially calculated at 2.5 million and the market rate for bonds with no conversion option is 8%. The bond is convertible in 5 years' time with 50 shares for every 100 nominal value. C pays a tax rate of 40%. Now, very simple. For your you have your profits. You have your profits. Now, these profits will be affected, will have an impact if the convertibles are converted. Correct. So, what will be the primary impact? The primary impact, number one, will be in terms of interest. Number two will be in terms of taxes. So, coming back, number one. So, let's take our profits. Our profits are going at 10,500,000. 10,500,000. That's our profits. Now, if the bonds are converted into shares, I will no more pay interest. I will have interest savings. My interest savings will be obviously they say we have calculated, they have already calculated, the 3 million bond has been calculated at present value of 2,500. Therefore, my interest finance cost is calculated based on 2,500. So, therefore, my 2,500 into how many percent is my interest? My interest is 8%. So, 2,500 into 8% gives you how much? 2,500 into 8% gives me? Sorry? No, that's for the we have already got the present value. So, here what we are trying to calculate is what is my finance cost saving. I have an interest saving. That's going to be for 500. Why 500? Because that 2,500 will be for the liability. Yeah, so on that only we pay interest, no? Hey, convertibles, recognize that present value. Take the value and after we put the T account and then we start calculating the interest. 2,500 into 8% gives me how much, my dear? 200. So that's going to be my future saving. So I am going to add my 200,000. That's my future saving. But I will lose my tax savings. So I will have my tax savings. How much is my tax savings that I'm going to lose? Of my 200,000, I will lose 40%. Of my 200,000, I will lose how many percent? 40%. So that will give me how much? 80,000. Therefore, my net adjusted profit will be 10,500 plus 200 minus 80,000. 10,620 will be my my numerator. Now I have to make sure that if the shares are converted, what will happen to my shares? So my shares will also be affected. No, my dear, there will be two impacts. Number one, my profit will be affected. Number two, my shares will be affected. So my convertibles will also be affected. Now already how many shares do I have? I have 6 million shares. So already I have 6 million shares, correct? So existing shares will be 6 million, correct? Now if I convert, I've issued the conversion where it can be converted into 50 shares for every 100 nominal value, correct? So therefore, my nominal value, my total value that I have issued for my convertible loan is how much? Superb. 3 million. 3 million I can convert for every 100 I can convert into 50 shares. So 3 million over 100 into 50 gives you half, no? 1,500. 1,500. Therefore, my adjusted shares will be 7,500. Therefore, my diluted EPS will be 10,620 over 7,500. Gives you 1.42. 1.42, option number D. Okay, now very simple. It can either be convertible bonds like this, or it can be shares only. If it is shares that you have given to your employees, that can also be in the future can be converted into shares. Now here, if it is a convertible bond, the impact will be both. The impact will be both on profits and shares. The impact will be both on profits and shares. Are we clear? Are we clear? Well, what are the balance that will appear in the statement of financial position? The statement of financial position as at 30th June 2014. Okay, what is this? Obviously, it's going to be income taxes. Now, the moment you see taxes in the exam, you know directly what needs to be done. Directly what needs to be done, you're going to simply put up 3T accounts in the exam. So, the moment you see an area, the moment you see an area on taxes, the easiest way to get taxes done is put up 3T accounts. Okay, so we are going to look at 3T accounts. We are going to look at 3T accounts in the exam. The easiest way to do any tax question is forgetting everything, simply putting up 3T accounts. You put up 3T accounts and you call the 3T accounts income tax. Number one, income tax account. Income tax account. Number two, tax payable account. Tax payable account. And number three, deferred tax account. So you got to make sure that you just simply put up 3T accounts in the exam the moment you see your taxes. Okay, step number one. Under this step number one, what you have to do is you have to take the brought forward figures. Brought forward figures can either come on the debit side or on the credit side. So based on the trial balance, you can directly take it, no problem. And then you have to go and check what is the tax charge for the year, current year. Your tax charge for the year, you will debit your income tax, credit tax payable under normal circumstances. If it is going to be a tax refund, you will credit your income tax and debit your tax payable. In other words, it's a tax receipt. And then you will account for the current year tax. How will you account for your current year tax? You will account for the deferred tax. How will you account for the deferred tax? Your deferred tax carried forward amount equals to accounting written on value minus tax written on value into tax percentage. You'll take your carried forward percentage here and you will look at the difference. Based on the difference, you will decide to take it to your income tax account, debit or credit side. Based on that, whatever difference comes in, you will take it to the P&L. We have done, I've given you steps. We have done so many questions on this already. Going back. What are the balances that will appear in the statement of, financial position as at 30th June 2014 for what? Number one, deferred tax. Number two, taxation. So in other words, they want for this and this because that is going to be my financial position. Superb. Now let's go back to the question. They say L has the following balances included on its trial balance at 30th June 2014. What are the balance? You have taxation brought forward 6,000 credit, and then you have deferred tax 24,000. You have deferred tax 24,000. The balance on the taxation relates to an over provision from 30th June 2013. At 30th June 2014, the director estimated that the provision necessary for the taxation on current year profit is 30,000. The carrying amount of L's non-current asset at this date exceeds the tax written down value by 60,000. The rate of tax is 30%. Okay, forgetting everything, I'm going to simply fill in my blanks. Taxation brought forward on my credit side, I have 6,000. So brought forward 6,000. And then what do I have? Deferred tax, I have 24,000. Brought forward 24,000. The directors estimated the current year tax to be how much? 30,000. The current year tax is going to be 30,000. Debit taxes, credit tax payable. Okay, so you're going to say TP 30,000. Tax payable, IT income tax 30,000. Are we clear? And then finally, what do they say? The carrying amount of L's non-current assets at this date exceeds the tax written on value by 60,000, meaning your carried forward deferred tax exceeds by 60,000, where you have to provide a 30% deferred tax liability. So your carried forward will be 60,000 into 30% gives you 18,000. Are we clear? Therefore, brought forward I have 24,000. So carried forward I'll take to my balance sheet 24,000. Are we clear? Oh no. Brought forward is it 24,000? Carried forward is not 24,000. Carried forward is 18,000. Carried forward is 18,000. Therefore, there is a difference of 6,000. I take it to my income tax account. So my income tax account, I debit my deferred tax, I credit my income tax account. So I'll come here, I'll say DT, how much? 6,000. Are we clear? Therefore, I have 30,000 here. I have 30,000 here. To my P&L, I'll take difference of 18,000 that will go to the P&L. But what is relevant for me in this question? What goes to the balance sheet? Balance sheet, number one, 18,000 will go. And then obviously number two, I have 30,000 here. I have 30,000 here. Carried forward 30,000. So obviously 18,000 and 30,000 will go to my balance sheet. 18,000 and 30,000 will go to my balance sheet. Answer B. Are we clear? Are we clear? Understood? Because they clearly say what will go to the statement of financial position. Well, yes, these types of questions will take some time. It might take about 2 to 3 minutes. I know. But you need to try to see where you can catch up this time also. Okay, super. An enterprise sells goods with a warranty. An enterprise sells goods with a warranty covering customers for the cost of the repairs. Okay, requirement, what provision should be made for the cost of the repairs? What is the standard? IAS 37. IAS 37. Provisions, contingent liabilities and contingent assets. Okay, superb. Provision. The accounting treatment for provision is dealt with mainly by IAS 37. Provisions, contingent liabilities and contingent assets. This is an area where there have been a lot of abuses, lot of confusions. This means that the rules are complicated by the need to deal with a range of eventualities. A provision is a liability. A liability. What is a liability? Liability is a present obligation. Obligation can either be contractual obligation, constructive obligation. Of uncertain timing, you do not know the timing, you do not know the amount when this liability will be paid. IAS 37 requires a provision should be recognized when an entity has a present obligation, legal or constructive, as a result of past event. It is probable that an outflow of resources embodying the economic benefits will be required to be settled. A reliable estimate, you can estimate the amount reliably. Provisions cannot be recognized in the absence of a present obligation. If there is no present obligation, you can't recognize a provision. Because companies have in the past recognized provisions in order to smooth out their profits, just to make sure that profits are smoothened, because provision is a judgmental area. Large provisions might be made in good years and then cancelled in bad years in order to create a steady trend in profits. This is particularly true in case of provisions for reorganization. Before a provision can be made, there has to be a detailed plan for the reorganization. Why your reorganization? Why you're undertaking a reorganization strategy? And the company must have raised a valid expectation in those affected that it will take place by informing your employees, by informing redundancy notices that there is a reorganization taking place. There is no formal definition of probable in the standard, but it is usually defined as more likely than not. For probability, we have certain guidelines, virtually certain, probable, remote, possible. The amount recognized as provision should be a realistic estimate. You should find a realistic estimate, a prudent estimate of the expenditure that needs to be settled in the obligation existing at the reporting date. discounted back to net present value when it is more than generally 1 year. Contingent liabilities and contingent assets. IAS 37 also deals with a contingent liability, a possible obligation that arises due to a past event whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. A present obligation that arises from past event but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Well, coming back. A contingent liability is generally disclosed in the notes to accounts. Okay, because if it is material, a compulsory disclosure is required. A contingent asset means you are looking at a possible future cash inflow, for example, insurance. Well, but not wholly within our control. But then again, even for contingent assets, we've got guidelines as to how to recognize in terms of probabilities. Okay, coming back. Here they are asking you what provision should be made for the cost of the repairs. Okay, what is the value of provisions that should be recognized? Okay, how much should you provide? Okay. Well, an enterprise sells good with a warranty, an enterprise sells good with a warranty, an enterprise sells good with an warranty, covering customers for the cost of the repairs. Okay, superb. Of any defects that are discovered within the first 2 months. Okay, remember we did McEljoy. Under McEljoy, I told you if there is a provision, how to work around it. It is an SBR question. I did it with you in class. After the purchase, past experience suggests that 95% of the goods sold will have no defects and 3% will have minor defects. And 2% will have major defects. Okay, for no defects, you are not going to provide a provision. You are going to provide provision for minor repairs and major repairs. So your minor repairs will be 2% and your major repairs will be how many percent? Sorry, minor repairs will be 3%, and major repairs will be 2%. If minor defects were detected in all products sold, the cost of the repairs would be 12,000. So cost of minor repairs will be 12,000. And if major defects were detected in all products, the cost would be 8,000 into 8,000. Sorry, it's 80,000. Therefore, the provision that is expected that you should provide would be 12,000 into 3%. How much is that? 3,000? 360. 360 and 80,000 into 2% gives you 1,600 plus 360 gives you 1,960. Provision of 1,960 has to be provided. Are we clear? We've done questions like this in the past. Okay, superb. Number 8. Okay. Favorite. In the consolidated statement of financial position at 31st December 2015, what amount should appear for NCI interest, meaning in the financial position? NCI share of net assets in the financial position. Are we clear? Are we clear? Shall we start doing it together? Okay. WCO acquired 70% of the share capital on 1st of January 2012. 1st of January 2012. Your year end is 31st December 2015. For how much? For 300,000. The goodwill arising on the consolidation has been impaired by 50,000. Okay, goodwill arising on consolidation has been impaired by 50,000 as at 31st December 2015. The share capital and reserves of the two companies as at 31st December 2015 were as follows. What do you have? Share capital, retained earnings of the parent and subsidiary. At the date of acquisition, PCO had retained earnings of 125,000. WCO measures the NCI interest at the proportion of net assets of the subsidiary, meaning you will not have NCI goodwill. Out. So in the consolidated statement of financial position, what will be your NCI interest? So to calculate NCI interest, NCI share of net assets in the consolidated statement of financial position, what do you need? Number 1. You need number 1, share capital. Your share capital will be how much? 150,000. And then what do you need? Retained earnings. How much is your retained earnings? 200,000. So they're not talking about any URP, nothing, just 200 plus 150, gives you 350,000. What is the NCI percentage? 30%. Gives you 105,000. Your NCI share of net assets. Answer A. There you go. That's it. That's it. Number 9. Okay, questions look big, but you see how simple it is to get the answer. It is not difficult. You are making it difficult. What will the balance on the consolidated retained earnings as at 31st October 2018 be? Consolidated retained earnings. Consolidated retained earnings, you know now, okay, parent, subsidiary, today at acquisition, correct? We know that, correct? Parent, subsidiary, today at acquisition, we know that, correct? Yes or no? Super. Benco bought 90% of ACO's 200,000 ordinary shares for 800,000. On 1st of July 2014, your year end is 31st October 2018, so it's not a mid-year acquisition. When the balance on A's retained earnings stood at 460, so when you acquired our subsidiary, you acquired it for 800,000 when A's retained earnings were 460. Retained earnings at acquisition. BCO measures NCI interest using the fair value model. Now there will be NCI goodwill. At 1st July 2014, the fair value of the 10% not owned by Benco was 6,000. They have directly given you the 10% not owned by Benco. That is the parent. See, little change in language, you get confused. Okay, what the hell is this? That's our investment cost. Generally, they'll say the fair value of NCI is 60,000. They are saying now not owned, 10% not owned is 60,000, meaning that is NCI. You will sit and wonder what the hell is this? You will be thinking and you will scolding me for hours and hours. You can scold me, but come outside and scold me. In the exam, try to finish this off. You can come out, put on conference call me and scold me. That's okay. At 31st October 2018, the balances of retained earnings of the two companies were as follows. Ben 1072, A 900,000. An impairment review at 31st October 2018 indicated that 30% of the goodwill on acquisition should be written off, meaning you have to calculate goodwill. So, number 1, what are we going to do? We are going to calculate goodwill, and then based on that, we are going to consider the impairment. So, goodwill on acquisition, our fair value, investment cost, our fair value. Our fair value investment cost is for parent 800,000. Should I do it on Excel so that it's easier for me also? So I'm coming back. This is mock answers. Okay. So my dear, I'm going to do my goodwill. For my goodwill, I need my fair value. Fair value of parent, fair value of consideration paid or investment cost, parent and NCI. So parent and NCI, parent they say is 800,000. Parent they say is 800,000. So I'm going to take my 800,000. NCI not owned by the parent, 10% is 60,000 equals 60,000. There you go. From this, what do? Acquired net assets. What are the acquired net assets? Share capital. How much is share capital? The share capital is standing at 200,000. Share capital is 200,000. And then any share premium? No. Retained earnings. How much is the retained earnings? At acquisition date, retained earnings is 460,000. So you're going to take your 460,000 equals sum. How much? 660,000 into how many percent? Into 90%. Correct? So equals this into 90% gives me 594. Therefore, 800,000 minus 594 gives me 206,000. Are we clear? Over here, 660,000 into 10%, not 594,000. Students make that mistake. 66,000, therefore you have a negative NCI goodwill. Negative NCI goodwill is 6,000, therefore my total goodwill will be how much? 200,000. If you take my 200,000 out of this, they say there is an impairment. Impairment of how much? They say there is an impairment of 30% of goodwill. Therefore, impairment 30% will be equals this into 30%. That gives me 60,000. Therefore, 200,000 minus 60,000 gives me 140,000. That's my net goodwill. But what do I need? My requirement is consolidated retained earnings. So for calculating consolidated retained earnings, I needed my this thing only. What goodwill impairment value. That's why I had to do my goodwill calculation. So consolidated retained earnings. What do I need? Consolidated retained earnings. I need parents retained earnings. Correct? Parents retained earnings. We know the methods. Correct steps. Parent retained earnings is how much? 1072. 1072,000. Correct? Subsidiary today at acquisition, and then we have goodwill impairment. Subsidiary today is how much? Subsidiary today is 900,000. When you acquired 460,000. Therefore, equals this minus this into how many percent? 90%. Equals this into 90% gives me 396. Are we clear? And then I can add these both plus I have what? Impairment to reduce. Okay, how much is the total impairment? Impairment is 60,000. Should I deduct the entire 60,000? No. 60,000 into 90%. Superb. 60,000 into 90% equals 60,000 minus 60,000 into 90%. 54,000. Therefore, my answer is 1414. Answer, do we have 1414? Yes, answer C. Are we clear? Are we clear? Are you sure? Understood? Super. Which of the following will be immediate effect of changing to the breakup basis? What is the breakup basis? When going concern is impaired, when you think your company is not a going concern company, then you prepare financial statements on a breakup basis, or we call it a liquidated basis. In a breakup or liquidated basis, you give a detailed disclosure of why your company is not a going concern, and then you will not have non-current assets. You will reclassify them as current assets. You will allocate them as current assets because obviously you are not going to continue for more than 1 year. If you are not going to continue for more than 1 year, you can't have them as non-current assets. W is a retailer whose only non-current assets are fixtures and fittings. The company has been experiencing trading problems for some time. The directors have concluded that the company is no longer a going concern and have changed the basis of preparing the financial statements to the breakup basis. Which of the following will be immediate effect of changing to the breakup basis? All fixtures and fittings are translated from current to non-current. Yes or no? Yes. Fixtures and fittings are revalued to their replacement cost. No, they are revalued to their sales price. Fixtures and fittings are revalued to their value in use. No. No impact on fixtures and fittings. No. Answer A. Are we clear? Assets are revalued to their sales value. Okay, you need to keep that in mind. Not replacement use, not value in use. It's sales value. Okay. Negative goodwill. Negative goodwill. Okay, we are coming to goodwill. So since we are in goodwill, let's immediately start looking at some notes on IFRS 10. IFRS 10 consolidated financial statements. Okay, primary area in your exam will be tested, will definitely be tested, will be tested for minimum 15 to 20 marks in the exam, can go up to about 25 marks. Group accounts could be examined as a part of a 20 marks question in section C. There could also be 5 mark objective case questions in section B. A group comprises 2 or more companies that are controlled as a single entity. PNS are separate legal entities in line with IAS 28, but in economic substance, IAS 27, but in economic substance, they are recognized as a single unit. Although you are separate companies for the purpose of consolidation, economic substance over legal form, we follow the concept, you can bring them together as one company. Group accounts combine the financial statements of the various group members and present the results as if the separate companies were a single economic entity. This is logical because they are by definition all under the holding company's control. Applicable accounting standards: IFRS 3, we know IFRS 3 is for goodwill, IFRS 10 for consolidation, and IAS 28 for investment in associate. What is a subsidiary? A subsidiary is an entity that is controlled by another entity, which is the parent. Control: for examination purpose, control is achieved based on ownership of 50% of voting shares. An investor controls an investee. An investor controls an investee. Number one, if it has power over the investee to make decisions, there is control. If you can make financial decision and operational decision, it has the exposure or rights to variable returns from its investments with the investee. It has the ability to use its power over the investee to affect the amount of the investment returns. It can say, okay, this is the amount of returns I want, or we will make sure that we will take the returns later. There are companies which you don't have to prepare group accounts. They are exemption. They are exempted. So exemption from preparation of group financial statements. There are companies where you don't have to prepare group financial statements at all. When do you have to not prepare? IFRS 10 gives us guidelines. IFRS 10 consolidated financial statement states that a parent need not present a consolidated financial statement if and only if, number one, parent itself is a wholly owned subsidiary of another company. Parent is being owned by another company or partially owned by a subsidiary. You are a partially owned subsidiary or 100% owned subsidiary, meaning somebody else is going to prepare the group accounts for you. Number two, the parent's debt or equity instruments are not traded in the public market. If you are not traded in the public market, then there is no risk of showing it as group financial statements. The parent did not file its financial statements with the Securities Commission or other regulatory commission. Okay, you are not filing your financial statements in a security commission. So meaning it's a part of your internal company. Number three, the ultimate parent company produces the consolidated financial statements that comply with IFRS and available for public use. Because of that, you don't have to do it because there is a ultimate public parent company which is doing it. Certain subsidiaries are excluded. It is generally not accepted to exclude a subsidiary from the consolidated financial statements. The only exceptions are highly unlikely to occur in practice. It can't occur in practice. If it occurs on the basis of materiality, it's not material subsidiary, so you ignore it, you exclude it. The subsidiary might be held for sale. In that case, you don't have to do it. So when you take the consolidated financial statements, in consolidated financial statements, as we already know, there are basic transactions that you need to eliminate. Now, what are the basic transactions that you need to eliminate? You know, obviously, if there could be intergroup trading. If there's intergroup trading, you know, between the parent and subsidiary, it has to be eliminated. If there's any loans, it has to be eliminated. The current accounts between the parent and subsidiary has to be eliminated, and URP has to be eliminated. So all these adjustments have been entirely taken through before, so I'm not gonna entirely give time entirely to take this through, but definitely I want you to go through this as a part of your revision so that you understand what are the areas that require your attention. Superb. But all these have been covered in detail. All these have been covered in detail when I did my classes with you. So you can always go back to my recordings, go through all what I have covered. Negative goodwill. We know negative goodwill. We've been speaking about negative goodwill. What is negative goodwill? When the purchase price is less than the net asset value of the company, meaning you're bargaining and purchasing. Or sometimes we call it not negative goodwill, you can call it bad will also. Sometimes they call it bad will. Not goodwill, they call it bad will. Then certain terms also call it a bad will, which is a gain on purchase of a business arises when the acquirer's interest in the fair value of the acquirer's identifiable net assets exceeds the cost of the business combination. Which of the following does IFRS 3 business combination state must be carried out when this arises? 1, 2, 3, 4. Answer. Hmm. Goodwill, IFRS 3, business combination revise. Goodwill treatment, if it's positive, capitalize annual impairment test. Negative, check calculations if the value is correct or not. Never capitalize, credit to statement of profit or loss. Answer. Which of the following does IFRS 3 business combination state must be carried out when this arises? Reassess the amount at which the consideration has been measured. Reassess, check calculation. Check if your values are correct or not. You could have gone wrong. Reassess. Number two, reassess the amount at which acquirees identifiable net assets have been measured. Number one, you check the consideration, your investment cost. Number two, you check the net assets, your calculations are correct or not. Check the calculations. Your investment cost, acquirers and acquirees, both net assets and the investment cost. Number three, take any excess to statement of P&L. So 1, 2, 3, I know that those are the conditions given. Now you see, you go back to my chart notes, you get the answer. How can I simplify it further? I can't do anything. This is a maximum I can simplify. I've simplified based on what is required for you. So recognize the excess in the statement of P&L over the life of the non-monetary asset. We never saw anything like that. Doesn't make sense. Answer 1, 2, 3, C. Are we clear? Very simple. My videos, my recordings will give you everything. No, you don't have the time. You are not an ArivuPro student. Okay, go back, take my chart notes, go ahead with my revision. But I know ArivuPro students have been messaging me asking, okay, how can I do it? This is the way going forward. But you will have my recordings as well. So whenever you feel an area is complicated, you can always go back to my recordings. Are we clear? Super. Number 12. Number 12. Let's read the question together. Read it. Read the question on your own. What figure should be shown for the purchase? What figure should be shown for the purchase of plant and machinery in C's statement of cash flows for the year ended 31st March 2015? For the purchase of plant and machinery. Okay, we have studied, we have come across this so many times before. Okay, statement of cash flows. If you are looking at statement of cash flows, what figures should be shown? Very simple. In your statement of cash flows, you have a little working to do. This is a little working to do. What is the work? What is the working? If it is property, plant and equipment, the moment you come to property, plant and equipment, opening net book value goes up with additions, goes up with revaluation, correct? Goes up or down with transfers from investment property or to investment property, comes down with depreciation, comes down with impairment. If there is any revaluation loss, it will come down, and it will go down with disposals. That gives you your closing net book value. It's a matter of filling this. If you fill this, you'll get the answer. Okay, take a minute, read the question. Take a minute, read the question. What is happening? The plant and machinery of C was shown at a carrying amount of 425,000 at 31st March 2015. So 31st March is your year end. So year end figure, filling in the blanks, 400 and not clowning net book value, it's closing net book value. Okay. 425,000, done. The comparative figure at 31st March 2014 was 350, meaning brought forward figure was 350, correct? Your opening net book value is 350. Your closing is 425. What are the information are they giving? During the year to 31st March 2015, the depreciation charge for plant and machinery was 52,000. So minus 52,000, minus 52,000. Done and dusted. Let's go further. And the machinery with a carrying amount of 45,000 was sold at a profit of 4,000. So you had a machinery which the carrying amount was 45,000. You sold at a profit of 4,000. So meaning your carrying amount they have directly given you how much? 45,000 minus 45,000. There you go. At 31st March 2015, a 20,000 payable existed. So there is a 20,000 payable that you have to pay to the purchase of plant and machinery during the year. So that means you have a 20,000 payable. So basically your total net book value should have been 253,425, but it's not 253,425, it is 425, meaning there is addition equals this minus this. There is 172,000 addition. Out of this 172,000, you want to know how much cash you paid. So 20,000 is still payable, meaning 20,000 you have not paid means you would have had 152,000. So total 172,000, this is your addition. Am I right? Out of this 172,000, you have still 20,000 left to play. 20,000 left to pay. Correct. That's what they say, right? There is a payable in relation to property, plant, and equipment. Meaning 152,000 would have been your cash payment that you have paid. Meaning answer B. Are we clear? So basically you understood this calculation, no, my dear? Okay. So you have 172,000 addition, new assets that you purchase. This 172,000 new assets that you purchase is your cash outflow. Clear? But they say as at the year end, there is 20,000 that you have not paid. So technically cash, how much you would have paid? 172 minus 20, 152. Got it? Got it? Got it? Super. Number 13. Which of the following could be possible reasons for this? Okay, what has happened? Cash generated from operations in the statement of cash flows. Cash generated from operations on the statement of cash flows is considerably lower than the profit from operations recorded in the statement of profit or loss. Cash generated from operations in the statement of cash flows. Cash generated from operations in the statement of cash flows is very lower than the profit from operations recorded in the P&L. Now we looked at a question like this. With cash flows and ratios, we saw something like this. So here they say cash generated from operation statement of cash flows is lower, is less than the profit from operations according to the statement of profit or loss. Which of the following could be possibly reasons for this? A non-current asset has been sold during the year at a large profit. Could that be a reason? A large payable was paid off just before the year end. A large sale was made just before the year end, resulting in many light items being out of stock at the year end. Purchase of new premises during the year has led to an increase in depreciation charge. Cash generated from operations. So you have cash generated from operations is considerably lower than the profit from operations. Meaning your cash generated from operations in the cash flow statements, which has got impact. What are the impact? Depreciation, non-cash items, trade receivables, trade payables, inventories. All those, the value that you have there, When you compare with your cash from your operating profits, it's considerably lower. Which of the following could be possible reasons for this? A non-current asset has been sold during the year at a large profit. So if you are selling a non-current asset at a large profit, our operating profit will have, our operations profit will have the profit element. Correct. Correct. Our cash flows, will it have the profit element? Yes or no? Disposal gain, will we have? What will we do with it? We will reduce it. Meaning if you reduce it, our cash flows from operations will come down. Our operating profits will be high. So there will be a big difference between my operating profits and my cash flows from operations. Answer A, number 1. So technically in the exam, I know this and this is out. C and D has to be my answer. Okay. A large payable was paid off just before the year end. A large payable will result in a decrease in payable or an increase in payable. It's good or bad for my cash? It's bad for my cash. Therefore, my cash flows from operations will drop. Meaning, there could be a difference. Answer 1 and 3. C. A large sale was made just before the year end, resulting in many lines being out of stock as at the year end. A reduction in inventories, a large sale. A reduction in inventories will be good or bad for cash. So will that be a problem here? No, that is out. Will be good for cash as less cash is in inventories. Because here there is a big difference between my cash flows. Huh? You choose option C. D. Sorry, option D. Sorry. It's option D, 1 and 2. So this is out because it cannot be lower because of this. Purchase of new premises during the year has led to an increase in depreciation charge. Depreciation is added back. Because depreciation is added back, it will have a reverse impact. So answer D, 1 and 3. Okay. See, I know the answer, but in the exam, what you can do is you can pick the wrong option. You have to be careful there also. Are you clear? You have to be careful there also.
One option right and the other one wrong.
Till you lose your marks. Which one of the following would normally explain an increase in trade receivable days? Would not normally explain. Would not normally explain. So, would not normally explain an increase in trade receivable days. If your trade receivable days are going up, it simply means that your customers are not paying you. Correct? Your credit control is weak or strong? Weak. Negotiating a contract extension with a major customer making up 75% of the company's revenue who had threatened to go elsewhere would not normally explain an increase in receivable days. Will this explain an increase in receivable days or will not explain? It will explain. So that is out. High staff turnover in the credit control department. My credit control department has new staffs coming in, so I don't have proper control over my credit. Will it increase my trade receivable days or decrease my trade receivable days? It will increase because my credit control is not strong. So it will not normally explain an increase in receivable days. Entry into an overseas market for the first time. We did this. New markets, we studied. Starting up a new website, meaning products are now sold directly to the public. People are going to pay to you directly. Meaning it will not explain an increase in trade receivable days. Answer D. Are we clear? Okay. which one of the following would not usually explain a fall in the return on capital employed? Which one of the following is would not usually explain? So which one of the following is not going to explain a fall in the return on capital employed? ROCE. Answer. Which one of the following would not usually explain a fall in the return on capital employed? Okay, a dividend has been paid to the shareholders. If a dividend has been paid to the shareholders, that will not explain a fall in the ROCE. Profit has fallen down? Yes. Properties have been revalued upwards? Yes, it will bring down ROCE. Assets have been acquired and released during the year? It will bring down ROCE. Meaning answer. So the first 15 questions are done. I'm going to give you 5 minutes to quickly go through the answers that we have done so that you are fine before we go further. I'm going to keep scrolling and I'm going to give you overall about 10 minutes to quickly go through. I want you to do it on your own. If you have any doubts, just let me know.
You pay for the export duty.
No luck, right, with the tickets. You guys understood, right? Understood, right? Yeah. We have another 20 days for the exams. You can practice really well. Start. We can do it. Not tough. Okay. 2 minutes for this. Let's take a coffee break and be back in 15 minutes. Okay. Understood? Yeah.
Place side to 9. basic. Study of later on question exam. Exercise full of covered. Massive score. AB last 1 week நீ அட்டஸ்ட்ல உட்கார்ந்து இருப்ப. லாஸ்ட் 1 வீக்ல உட்கார்ந்து பிபி கம்பெனி பண்ணி இல்லைன்னா ஒரு நாளைக்கு 20 கொஸ்டின்ஸ் இப்போ இருந்து செட் பண்ண கூட உங்களுக்கு கப்ளான் ஒரு 20 கொஸ்டின்ஸ் ஒரு நாளைக்கு அந்த மாதிரி ட்ரை பண்ண மொத்தமாக ப்ராக்டிஸ் பண்ண நீ பாத்தியா இன்னைக்கு வந்து யாரு வீட்டுல கண்ணுக்கே தெரியல கணக்கு தெரியும் அப்ப நான் சீரியஸ் வாட்ச் பண்ணிட்டு இருந்தேன் அதனால தெரியும் நான் சீரியல் இல்ல சீரியஸ் இது பிரேக்ல சொல்றேன் மார்னிங் நான் சீக்கிரம் வந்து 8:30க்கு ஸோ 9 சார் வரைக்கும் நான் பார்த்துட்டு இருந்தேன் நீ லேட்டா வந்த நான் இன்னைக்கு சொல்றேன் இன்னைக்கு வந்து பார்த்தேன் நான் பார்க்கல இன்னைக்கு நேற்று வரல சீரியஸ் பார்த்துக்கணும் நான் பார்ப்பேன் வீடியோ செஷன் முடிச்சிருக்கலாம் ஸ்டார்ட் பண்ணணும் ஸ்டார்ட் பண்ணி முடிச்சிருக்கேன் அதெல்லாம் நான் நாளைக்கு maybe nothing only recording யாரோட ரெக்கார்டிங் சாரோட இன்னும் உட்காந்து பார்த்தியா வாவ் I used to write in the evening. Morning now best. Bro, when did you put your exam? The long one. Or when the class was about to finish. Okay. But then I received a mail that my exchange from Tamil Technologies to another place in Mahanagara. You got a mail. July, May. When did you book? After classes. Morning have to go. Honestly, very 9%. நீ வீட்டுல அலோவ் பண்ண மாட்டாங்க பிரச்சனை வீடு நான் கெஞ்சி கூத்தாடியாச்சு ஃபர்ஸ்ட் இயர் காலேஜ் எங்க கம்ப்ளைண்ட் பண்ண போறீங்க சார் வந்துட்டாரு எக்ஸாம் புக் பண்ணியா சம்ஜி நான் தர மாட்டேன் You know what? Yesterday I went and told him, you know, அங்கேயே வாட்டி சொல்லுறேன் இந்த மாதிரி என்னை கூப்பிட்டு கேட்டாங்க சஸ்பெக்ட் I'm angry. Laughing. How dare they ask you 3 times the same thing? Neither thing for young people. I said, teacher, our one he knows only this. Even because he only take the admission. So whatever problem he talk to you. And the money, wait, I'll call the patient. That's not a big problem. I think today he has someone asked me. Morning then நான் போய் கேட்டேன்
It's okay, don't mention the name.
Don't mention the name of this.
It's okay, it's fine. I think you and me spoke again. அப்பதே நான் சொல்லலாம்னு நினைச்சேன் அப்படின்னு சொன்னேன். I thought I didn't tell that. Point of lying.
He's lying, but I'm sure you know that she's.
What's the point of
I have to tell you she's lying about it.
Monday and then no idea. They close the ticket saying there's no study.
Reply on this.
They close the ticket.
Close the ticket means put it.
They have sent respond automatically. They called me without considering. She asked me, I said all the concern in the money, they made us still find what is this. Okay, ma'am, I'm sorry for your inconvenience. We'll find out the beginning. So I'll call you back to solve it. When it's saying that it's not permitted to cover for that, still reply பண்ணி கேட்டேன், what about the days for the students? In the morning, our students, where will we go? Please give us the access to the lobby. Old building lobby actually empty and nobody students sit there. No parents are going to come. Now again she has replied saying no, nobody should sit there. Needs to be informed the lobby is not permitted to study hall. That's because convenience to students and parents. From 2 AM onwards, we appreciate the cooperation in maintaining comfortable and respectful learning environment. அதுக்கு மேல ரிப்ளையும் பண்ண சொல்றாங்க. Further clarification, it will directly leave for the Chennai academy. படிக்கிறது ஏதாச்சும் அலோவ் பண்ண முடியும். நிறைய பேர் வந்து ஹாஸ்டல்ல இருக்காங்க, அவங்களுக்கு நம்ம படிக்க கம்ஃபர்டே கிடையாது. அதனாலதான் இங்க தேடி வராங்க. But nobody is fighting. Only me and her are fighting. Because at least that's the access. No, others understood and they went, but we are not understanding. We want them to follow wrong.
Hey, you going good? ஆனா உங்களுக்கு ரொம்ப தூரமா இருக்குமோ அந்த
அண்ணா இது எவ்வளவு கிட்டதான் நான் பிரச்சனை இல்லை, பட் அவ வந்து வீட்டுல சொல்லிட்டு வரா, எனக்கு ப்ராப்ளமே கிடையாது. ஓகேவா? இப்ப அவ வீட்டு சைடு அங்க இருந்து ரொம்ப கிட்டது, பேரண்ட்ஸ் அங்கதான் இருப்பாங்க. சம்டைம்ஸ் அங்க இருந்து வெளியே வரது அவளுக்கு பார்த்தாங்கன்னா she will have a problem.
They will ask, why did you tell me directly? If I tell, like, I'm going to library, they will say everything is there at home. Why don't you study in home? புரியுதா?
But they don't understand. வீட்டுல எல்லாம் படிக்க முடியாது.
பட் எனக்கு அந்த ரூம்லயே உட்காந்து மீட்டிங் இன்னொரு ப்ராப்ளம் இல்லை. வீட்டுல இருந்து மார்னிங் ஹவர்ஸ்ல படிக்கவே முடியாது. வீட்டுல அவங்க ஏதாச்சும் ஒர்க் சொல்லிட்டே இருப்பாங்க. பட் உனக்கு ஸ்டேபிள் உனக்கு ஸ்பேஸ் இருக்கு. பட் மார்னிங் என் டேடி முன்னாடி Bro, we will sleep. You're saying you're ready. You know what? This is para. Para.
போனாலும் ஒரு யூஸும் இல்லை.
எடுத்து பேசணும். நேற்று சிஏ பசங்க ஏதோ பெரிய சண்டை போட்டுருக்காங்க. ஆமா, இவ்வளவு பெரிய கும்பல் என்ன பேசுறாங்க.
அது அந்த கும்பல் வந்து ஆக்சுவலி சார் வந்து வெளியே துரத்தி விட்டாரு அந்த கும்பலை ஃபுல்லா. அவங்க ஏதோ பிரச்சனை பண்ணாங்க. ஆக்சுவலி நேற்று கிளாஸ்ல தானே சொல்றேன். அவங்க வந்துட்டு பர்டிகுலர் ஸ்டூடெண்ட்ஸ் இருந்தாங்க. அந்த ஸ்டூடெண்ட்ஸ் வந்து வெளியே துரத்திட்டாங்க. எனக்கு ரொம்ப டிஸ்டர்பன்ஸா இருக்குன்னு சொல்லி அந்த கேங்க ஃபுல்லாவே வெளியே துரத்திட்டாங்க. ரொம்ப கடுப்பா வருது.
1-2 days
எனக்கு வந்து அண்ணா சாலைதான் போயிட்டு படிச்சுட்டு இருந்தேன். பட் எனக்கு ஆக்சிடென்ட் ஆனதுல இருந்து அந்த சைடு போகவே எனக்கு ஒரு மாதிரி தயக்கமாவே இருக்கு. சொல்ல போனாங்க
22 இல்லைங்க, சரியா? 24. காஃபி பிரேக் பண்ணவே இல்லை.
அவங்க யார்கிட்டயாச்சும்
கூலி டிக்கெட் வாங்கி
இல்ல அந்த கார்னர்ஸ் எல்லாம் டைரக்டா இருக்கு.
ஸ்பிங்கர் இருக்கு. ஸ்பிங்கர் எல்லாம் போட்டெல்லாம் மேல அந்த சைடு வராது.
இங்க வரலாம். ஆக்கி பண்ணல வந்துட்டேன்.
ஏசி பழகுனவங்களுக்கு ஓகேவா இருக்கும். பட் ஆனா எக்ஸ்பீரியன்ஸ் கரெக்டா இருக்குமா, நல்லா இருந்துச்சு.
பிரச்சனை அவர் நோட்ஸ் எல்லாமே இருக்கு. நம்மளுக்கு நோட்ஸ் கொடுத்தாரு, நம்ம எக்ஸல் டைப் பண்ணி வச்சுக்கலாம். நோட்ஸ் இல்ல அங்கங்க விட்டு வச்சிருக்காரு கொஞ்சம்.
சோ இது பாக்கெட்
போய் டவுட் கேளுங்க. அது பாக்கி வச்சு அது சொல்லவே தெரியுமா? அதோட நானே இன்னும் சாட்ஜிபிடில போட்டு
I wanted you guys to come back to me for that.
ஒரு क्वेश्चन
இந்த மேரத்தான்
ஏதோ ஒரு கன்சாலிடேஷன்ல கூட குட்வில்ல உனக்கு வந்து மைனஸ்ல வரும். குட்வில்ல ஒரு 7 ஆஃப் போட்டுச்சு. போட்டதுல இதுதான் நான் சொன்னேன்ல.
All done. Okay. So there you go. We have finished off the first 15 questions, and we have another 15 more questions to do. Correct? Right. Superb. So coming back, we are moving on to section B. Section B. Section B, we have a scenario. We have a scenario, and under the scenario, we have about 5 questions. So we are going to work with these 5 questions under the scenario. So in other words, we have to go through the scenario completely, entirely, to understand what the requirement is. Okay. Super. First in the exam, for us, what is important is the requirement. Now, before reading the question, I'll go to the requirement. What does the requirement say? Which, if any, of the following statements regarding agency sale is or are correct? Which, if any, of the following statements regarding the agency sale is or are correct? So there is an agency sale probably. Okay, there is an agency sale probably. We know what is an agency sale, and they have asked for the right or wrong answer. Okay, Subhab, take a good 2 to 3 minutes, read the scenario to understand the scenario. Read the scenario. Superb. Now in the exam, which if any of the following statements regarding agency sale is correct? I know, okay. Generally your examiner connects 1, 2, 3, 4 to these areas. Generally that's how it's connected. Okay, that's how it is connected. Generally that's how it is connected. So you should know, okay, which requirement is relevant for which scenario, which note. The following is an extract from Miller's trial balance at 30th September 2014. Extract. Freehold property carrying amount, investment property, convertible loan note, revenue, cost of sales, taxation, deferred tax. The following information is relevant. Revenue includes 10 million for goods sold by M. Revenue includes 10 million for goods sold by M, acting as an agent for Thomas. So you are selling goods on behalf of another party, but you are an agent. M earned a commission of 15% on these sales and remitted the difference of 8.5 million in cost of sales. Revenue includes 10 million for the goods sold by M, but you only get 15%. Okay, what is this transaction known as? What is this transaction known as? Sorry? Agency relationship, where you have an agent to do the sale on behalf of you. Okay, so in this case, how much of revenue should you recognize? Your commission only. We saw this today. Your commission only. How much is your commission? 10 million into 15%. So meaning you have to recognize how much? 1,500 revenue. Okay. Now let's go to the requirement. Revenue should be reduced by 10 million. Correct or incorrect? Correct or incorrect? Cost of sales should be reduced by 8.5 million. Correct or incorrect? What is correct? Revenue should be reduced by 10 million. Is it correct? Should be reduced by how much? 85% should be reduced or should be there? It should be reduced, meaning this is wrong. You can't have 10 million. You should have 1,500. So you don't reduce by 10 million. You reduce by 8.5 million. So that is wrong. Statement 2. Cost of sales should be reduced by 8.5 million. Correct or incorrect? Correct. Statement 2 is correct. Answer B. What should be recorded in other comprehensive income in relation to the property revaluation? Okay, there's property revaluation that they're talking about. At 30th September 2014, freehold property has a fair value of 41 million. Freehold property 38 million is your carrying amount, net book value. They say it has a fair value of 41 million. And investment property, which is this, is considered to have a fair value of 31.5 million. Okay, meaning from 32.5 million, the value has dropped down to 31.5 million. M uses fair value to value properties wherever permitted. Now they want to know what should be recorded in other comprehensive income in relation to the property revaluations. In other comprehensive income. So they are talking about only other comprehensive income. Which one will take you to other comprehensive income? Freehold property or investment property? Freehold property only, you will take it to other comprehensive income. Investment property, you won't take it to other comprehensive income. Okay. So 38,000, but the fair value is 41,000, means how much is the extra? 3,000. So 3,000 should be your revaluation gain or revaluation loss? Gain. Answer? Answer. How easy it is. Are we clear? What should be recorded as initial liability in relation to the convertible loan notes? Convertible loan notes. Okay, they have a convertible loan note. On 1st of October 2013, MCO issued a 10 million 4% convertible loan note, which is repayable on 30th September 2017. Miller Co. chose to issue the convertible loan note as it meant that there would be a lower finance cost than the 8% interest rate charged on similar loan notes with no conversion option. The present value is given for 4% and 8%. Okay, very simple. What are you going to do? You have a convertible Convertible loan note. You're going to recognize that. Recognize that present value. So recognize that present value. How many years? Year 1, year 2, year 3, year 4. What are your cash flows? And then you take your discount factor, then you take your present value. Your cash flows will be 10 million into 4%. Correct? So equals 10,000 into 4%. 400, 400, oops, 400 and last year 10,400. Your discount factor at what percentage? 8%. 0.93, 0.86, 0.79, 0.735. Okay, therefore you get your present value equals this into this 372 7644. Therefore your loan recognition value will be 8676. Your loan recognition value, your loan receipt value is how much? 10,000. So there is a difference. That difference will go to equity, component of equity. Now what do they need? They want to know the loan recognition value, initial liability. Answer? Answer? How should the convertible loan note liability be accounted in the subsequent period? Fair value through OCI, no remeasurement, amortized cost, fair value through P&L. Amortized cost. Don't ever come and tell me this is tough. They will. So only few know here. What tax expenses should be recorded in the statement of profit or loss? Tax expense. Tax expense. Tax expense. This time they're talking about tax expense. Okay, fine. Take a minute. Go through. Go through. Go through. Okay, we've covered. We know how to do it. Yes or no? Take a minute. Try to do it on your own. Or just try to do it on your own. You know what you need to do. You need to put up how many T accounts? 3 T accounts. Okay, try to do it on your own. Let's see. Three T accounts. Do it like how we do it. Giving you about few minutes. Do it on your own. Again, your point. The directors have estimated the provision for income tax for the year to be 5.7 million. The taxation balance and the trial balance relates to under our provision. The required deferred tax is 7 million. Okay, all the information is given. All the information is given. Answer?
2075.
2075. Do you have? Yeah, I've got a 2075. Is that the right answer, everybody? Is that the right answer? 2075? Is that the right answer? Okay, let's check. Let's check. As always, we're going to put up 3 T accounts. Okay, can I put 3 T accounts? Do I have any T accounts done? Well, I don't see any T accounts now. Okay. Let me put 3 T accounts quickly. Okay. First T account, income tax account, and then tax payable account and deferred tax account. Income tax account, tax payable account, and deferred tax account. 3T accounts. Okay. Once I've taken my 3T accounts, what do I do next? I have to take my brought forward figures. What are my brought forward figures? I go here. My taxation 125 on my credit, deferred tax 10,500 on my credit. So my taxation brought forward 125 and here brought forward 10,500. They say the directors have estimated the provision required for income tax for the year to be 5,700. Debit income tax, saying TP, how much? 5,700. I come to tax payable, I say income tax 5,700. Done. And then finally, they say there is a deferred tax provision required of 7,000. So carried forward, how much? 7,000. Therefore, equals 10,500 equals 10,500, and you have a difference of 10,500 minus 7,000, 3,500. Where do you take it? Income tax account. I debit or credit? I credit 3,500. Okay, there you go. 5,700. 5,700. I have a difference of 5,700 minus 3,500 minus 3,500 minus 120. 3,500. Oops. Minus 125 gives me 2,075. My income tax charge the P&L. Answer 2075. You think it's easy because you're getting the answer now, or is it actually easy? The case study is easy.
Yes.
Okay, the case study is easy. Okay, fine. Let's see if we have a different difficult case study then. Okay. Okay, so we have completed the case study in 15 minutes. Okay, meaning we are cool. We are good. Okay, there you go. Let's get into the next case study. Which of the following items should be added to profit from operations in order to calculate cash generated from operations? Okay, there you go. You have something a bit technical now. Okay, fine. Take few minutes, read the scenario on your own, and then we will do it together. Yeah. Okay. Extracts from the financial statements of SECO are given below. Extracts of the statement of financial statements of SECO are given below. Current assets, inventory, receivables, cash at bank, in hand, deferred tax, trade payables, overdraft, taxation. Statement of profit or loss for the year ended 31st March 2017 is also given. Profit from operations, taxations. Additional information. An item of plant was sold for 915,000 during the year, resulting in a loss of 50,000. Depreciation for the year was 93,000. Which of the following items should be added to profit from operations in order to calculate cash generated from operations? Movements in inventories. Are you adding? Movement in receivables. Movement in payables. Yes, brilliant. Answer 3, answer C. Superb. Increase in payables should be added as it is good for cash. Obviously, it's good for cash. Increase in inventories and receivables are obviously going to have a minus impact on your cash. Superb. Good one. Which if any of the following below is or are correct? Depreciation should be added back to profit from operations in calculating cash generated from operations. Loss on disposal should be added back to profit from operations in calculating cash generated from operations. Answer? Answer? Answer, both statements are correct. That's right. What amount should be recorded in the statement of cash flows in relation to tax paid? In relation to tax paid. Okay, once again, tax is your favorite area. Okay, fine. This time I'm going to give it to you once again for you to calculate tax paid. Let's see. Let's see. If you get this right, after this, I'm not going to do a tax question with you ever again because you have mastered it. Tax paid is what they want from you. Okay. Answer? Okay. Want to go to the question? What amount should be recorded in the statement of cash flows in relation to tax paid? Answer C.
Sir, can you go to the balance sheet?
C. It's easy, you know. You guys told me it's easy, And you can't get time. I mean, your exam is not for 15 hours. Okay, no answers? No answers? 622. I got one answer, but let's see. As always, what am I going to do? I'm going to put up 3 T accounts. What's Celia? Answer? Okay. There you go. Okay. Let's try to understand. You have your deferred tax brought forward, which is 108, correct? Okay, we are going to take the brought forward figures now, obviously. Yes. So we have taxation under current liabilities and deferred tax under non-current liabilities. So deferred tax brought forward 108. Carried forward 234. Done. Your tax payable brought forward. Your tax payable brought forward is 250. Carried forward. Carried forward. They say it is 300. Okay, no problem there. So far, all good. Correct? Correct? No problem there. During the year, there is income tax charge of how much? 672. Now you are going to debit your income taxes, saying TP tax payable. How much is it? 672. 672. But this is all finalized, right? This is all finalized, right? This 672, will it include the movement in deferred tax? Yes or no? It will include. So when I'm paying tax, I have to remove the impact. I have to remove the impact. Okay, how will I remove the impact? Obviously, equals 234 equals 234. 234 minus 108. I would have taken 106 here included in 672. Correct. My 126 is included in my income tax. Correct. Correct. So that impact has to be removed when calculating my tax payable. Basically, what will be the movement in my tax payable? Basically, I have 672. Here, I would have technically taken 672, but no, the impact of deferred tax has to be removed. Meaning equals 672 minus 126 gives me how much? 546. I debit my income tax, I credit my tax payable. Meaning, in that case, equals 546 plus 250, 796 equals 796 plus minus 300 gives me 496. That will be my cash. (496) answer A. Obviously, no. It's a temporary difference, no. The temporary difference has to be removed, no. So my income tax would have my deferred tax impact. So they have directly given me that. So that has to be removed and only shown in my tax payable account. That won't impact my cash.
We do the tax payable and deferred tax together in a single account, it will get adjusted.
Correct. You can do your tax payable and deferred tax in a single account and get the answer also. You can get it. How can you do it? Okay, you'll take the brought forward here 250, deferred tax they are brought forward 108. So you'll take the both together, add it, carry it for 300 plus 234, account for the difference, you will still get it. No problem. You still get it. But that's not the method that we were looking at. We are looking at 3 T accounts. But simply you need to understand what is happening here. Now, if you don't understand that, you will not be able to take the 2 T accounts, 2 values together and do it anyway. Correct. You need to understand what is happening. The deferred tax implication has to be removed because this includes it. It's a movement. Are we clear? No? Okay. Now basically you would have taken your brought forward deferred. Now forget about everything. Now we are working it backwards in simple terms. Okay. Now let's take brought forward deferred tax 108. Normally they would have given us no. Carried forward 234 no. Okay. Now if you look at the difference, you have 126 no. Correct. Basically your tax for the year, they have how much they have debited? 672. It wouldn't have been 672 is what I'm saying. The tax would be 672 minus 126. Which would have been 546. Technically, it would have been here 546, 546. It would have been 546. What we would have done is we would have brought this 126 and made this 126, correct? From there. That's how we do it now. So we debit income tax and credit our deferred tax. Now what we would do is we would obviously take the total 672 equals 672. To our P&L we would take 672. This is how we used to do, correct? This is how we used to do, correct? But here the problem is your examiner has directly given you your 672. But what is relevant for us is 546. This should have been 546 here. The impact of deferred tax is captured. You need to remove that. You need to remove that in order to get the cash amount that is paid. Now do you understand?
Same way we have tested for this finance cost.
Yeah.
We have the
Interest payable.
timeline for money and the cash.
Correct. But you need to understand the logic. What is happening? If you understand the logic, it's not tough at all.
Cash paid and the timeline of money and so then
Okay, you will have one or two surprises. Okay, it won't be as easy as you think. Okay, of course, yeah. If they directly give you this, my dear, 672, this includes a deferred tax impact, no, my dear. That has to be obviously removed. How do we do it? Now, it's like this. I have given you the format. You can't expect you can copy paste this format and get the answer in the exam. No, you have to apply some logic into it. You have to think through. You can't directly get, any tutors can't do it for you. I'll tell you that. Any tutors can't do it. The steps are given as a guidance. You need to think how to apply the steps. Generally, what your examiner does is 546 is directly given. You go and calculate the impact of deferred tax. Correct? And now the moment you have to work reversely, you get confused. Okay, what the hell is this? But yes, better late than never. We did not have to sit and figure it out in the exam. We figured it out now. So you know, you're prepared. Are we clear? Are we clear? Understood? Yes or no? Yes? Superb. Let's go further. Okay, so it's getting a bit tough then. 24. What should be shown in the statement of cash flows as the net increase or decrease in cash and cash equivalents for the year? As the net increase or decrease for cash and cash equivalents for the year. So your net increase or decrease would be your net increase or decrease in cash and equivalents you will have in the exam generally. To this you will add your opening cash and equivalents will give you your closing cash and equivalent. Correct? Correct. Now they want this as your balancing figure, meaning you have to find out opening cash and equivalents. You have to find out closing cash and cash equivalents, and you have to rework it backwards. See, you're reworking it backwards. Okay, let's see how you're getting it. Go on. I've given you the formula. Let's see. Let's see.
So then decrease of 5,816.
Okay. Answer. Decrease of 5860. Okay, everybody? Okay. Done? Any other answers? Done? Okay. Let's see. They say cash at bank and in hand opening 7518. Correct? So that means my opening cash and cash equivalents, I have 7518. So I can simply take my 7518 positive. My closing cash and cash equivalents is how much? 1658 minus my overdraft 2123.
So overdraft will not be shown in working capital changes, sir. In
Okay, that is my closing cash.
Okay.
That's my closing cash means I have an overdraft with me. So my closing would be, if I set off 1658 equals 1658 minus 2123. We did this question called Kingdom where we had a negative 400 closing balance. Meaning if I had to work towards my net increase or decrease, my net increase or decrease should be higher than my opening cash and cash equivalents. Only then it would result in a negative overdraft figure. Meaning equals 7518 plus 465. But this has to be a decrease figure minus, so it gives me my answer of 465. So basically if I have to rework this, my net decrease is 7993, my opening is 7518, meaning I have 465 negative overdraft. I think for this particular question you are losing all the marks that you've gained. So now you see why you end up in 50-55. You can't leave the overdraft. How can you leave the overdraft? Answer 7983, decrease, answer C. You have to be very, very careful because they will confuse you. See, when you know straightforward your steps, you know, but if you have to rework it behind, you are messing it up. Now this becomes my X figure, balancing figure. So I am working from backwards. Now guys, I know if you have to come from top, you will easily get the answer. You'll tell me, oh, closing cash and cash equivalents minus 465. You are so used to it. But a new area where the same concept but a little change in your approach, you're finding it difficult. Now that's where a lot of improvements is required. Are we clear? Okay, super. Where should the sales proceeds from the sale of the plant be shown?
Investing.
Okay, cash generated from operations, operating activities, investing activities. Answer C. That's done. Moving on to the last part of our section B. Last part of our section B. So yeah, there you go. Finally, favorite area for most of us, lease, which is a very straightforward area. You know for advance what to do. You know for arrears what to do. You know what is rights of use. You know what is sale and leaseback. Yes, you know all those. It's not new for us. We know how to recognize a lease liability. Okay, fine. Requirement. Which any of the statement below regarding the lease of plant is or are correct. So probably they are talking about a lease plant, which I believe is my first item. But anyway, I'll give you some time. Go through the first item on your own. Answer. Okay, let's see the question. P leased an item of plant on 1st of April 2015 at a cost of 100,000 per annum with rentals payable in advance. The primary lease term is for 5 years and the machine is expected to have a useful life of 7 years with no residual value. The interest rate implicit within the lease agreement is 8% per annum and the present value of the total minimum lease payment is 431,200. Superb. Which, if any of the statement below regarding the lease of plant is or are correct? Statement 1. If the plant was only to be leased for 2 years, there would be no need to capitalize the right of the use asset. Correct or incorrect? Incorrect. Statement 2. If ownership of the plant transfers to P at the end of the lease, the plant should be depreciated over 7 years. True or false? Really? Are you sure? Yes, that's correct. Statement 2 is only correct. Theory, we have covered this.
You're not mentioning we take the lower.
That is if it's not transferred.
Yeah, if they didn't mention it's going to be transferred, we take 5 years.
Correct. But they are transferring, no. Then it's prudent for you to use 7 years. What will be the non-current liability be in relation to the leased plant? In relation to the leased plant at 31st March 2016. 31st March 2016, you're acquiring on 1st of April 2015. Meaning after 1 year. So that means you will put up your T accounts until 2 years, until the second year. Okay. Very simple. You are going to put up the T account. You are going to put up a lease liability account. Simple as that. In the exam, you are going to put up a lease liability account. So let's put up a lease liability account. A lease payable account. So you have your lease payable account. Okay. Your brought forward, how much is the present value they say? The brought forward value they say is 431, 200. So 431, 200, 431, 200. There you go. And then you have cash payments to make, and then you have your finance cost. As simple as that. Your finance cost is at 8%. Your cash payment is 100,000. Filling in the blanks in the exam. 100,000, and then finance cost is 8%. But it is in advance or in arrears? Advance. Therefore, equals open bracket this minus 100,000 into 8%. Done and dusted. At the end of the first year, equals sum. I take this, carry it forward, equals this minus this, gives me my answer 357,696. But I'll have to go until the second year. My brought forward is how much? 357,696. Copy, paste, done and dusted. So I have 278,317. Am I clear? 278,317. 278,311. So I have this. Now basically what should I do? I should give my non-current liability. My non-current liability always in the exam will be what? This is my A, this is my B, this is my C. Always in the exam, B minus C is my non-current liability. If it's advance, B minus C is my non-current liability. So my non-current liability will be B minus C. How much is B? B is 278,311. My C is 20,615. So equals this minus this. Answer 257,696. It's my answer. B minus C. If it is in arrears, it's there you go. Okay, so I can go back. My answer, what is the answer? 257,696. How much did I get? 257,696. Answer A. Steps, you get the answer. What is the value of right of use asset recognized by P immediately following the sale and leaseback transaction? So I believe that is the second scenario. Right of use recognition for sale and leaseback. We know the formula. They want to know what is the value we are going to use. Okay, take a minute, read the question on your own. P also entered into a sale and leaseback transaction for a machine at the beginning of the year. At the date of transaction, the machine had a carrying amount of 2.4 million and was sold for its fair value of 6 million. The sale represents satisfaction of a performance obligation in accordance with IFRS 15, it is a sale. So sale and leaseback, if it is a sale, it's very simple. What you have to do, rights of use has to be calculated. The machine was leased back for 5 years at the present value of the annual lease payment amounted to being 4 million. The machinery had a remaining useful life of 10 years at the date of sale. Okay, so rights of use. How to calculate rights of use? Formula: your rights of use equals book value over fair value into minimum lease payment. Correct? Very simple. How much is your book value? Your book value they have given, they say it had a carrying value of 2,400 carrying value, and fair value is 6 million, and then your present value of minimum lease payment is 4 million. So your book value BV, FE, MLP. BV is 2,400, FE is 6,000, and MLP is 4,000. Therefore, equals 2,400 over 6,000 into 4,000 gives you 1,600. That is my rights of use. Answer 1,600, 1.6 million. Are we clear? Are we clear? I did not teach. What is the impact on the statement of profit or loss for the year ended 31st March 2016 of the lease of office furniture? Okay, I think they're talking about some lease of office furniture. Okay, that is this. Okay, there you go. Take a minute, read it. Are we clear? Are we clear? On 1st of October 2015, P entered into a 5-year lease. 1st of October. Okay. For some items of office furniture with a 10-year life. 10-year life. Under the terms of the lease, P will pay 5,000 annually in arrears. You know, okay, under lease you can get exemptions where if it is a short life asset within 1 year or not material value, you can just expense it. And present value of the lease payment with an implicit rate of interest 8% was 20,000. P has applied the exemption available under IFRS 16. So meaning you are not going to take it as rights of use, you are simply going to expense it. So it's okay. Now, when comparison to all these 4 million, 2.4 million, when you see 5,000, it's okay. So, what is the impact on the statement of profit or loss for the year ended 31st March 2016 of the lease of office furniture? What is the impact? How much are you going to charge? How much are you going to charge? Rental 2,500, depreciation 2,000, finance cost 800, rental expense 5,000, depreciation 4,000, finance cost of 1,600. I just want to know the treatment. Are you going to capitalize it or are you going to expense it? Expense it. So that means if you are going to expense it, this is out, correct? Only if you capitalize, you're going to calculate depreciation. So that is out. These two out is in the exam. So either it has to be A or C, correct? Answer?
Because 6 months.
Answer A. 1st of October 2015. Your year end is 31st March 2016. 6 months, superb. 5,000 into 6 over 12. Answer A, superb. That's your rental expense.
More than 10,000 means we should not capital. We should capital.
On what basis are you saying? Did I ever tell you it's 10,000? Did I ever give you? In your answers, in your questions, they would have given you just a area for 10,000 to confuse you. Have I ever spoke to you about 10,000? They would say, okay, capitalize if it's over 10,000. You would have thought, okay, so standard says more than 10,000, you'll go and take that. I never told you anything like that. They're just giving you to confuse it. It is an option by the company, let's say, to understand based on materiality. Materiality can change from one company to another company. So there is no rule like 10,000. Are we clear? Don't go and get caught. Finally, which if any of the statements below regarding the lease of asset is or are correct? All leases will result in recognition of a rights of use asset. Correct or not correct? Not correct. If a sale and leaseback arrangement does not meet the definition of a satisfaction of a performance obligation, that is, it is not a sale, the receipt of cash should be accounted for as the receipt of a loan. Correct or not correct? Correct. Statement 2 is correct. All 30 questions, we are getting 100 marks. Are we clear? Are we clear? Understood? Yes or no? Are we clear? Okay. Let me give you a quick 5 minutes to quickly go through all what we have covered so far. Quickly go through on your own. So to see if there are any problems. This time is given for you to go through the answers and ask for any doubts that you have. If you want, I can put it for tomorrow.
What is there in this question? I
Huh?
can see which questions.
I haven't checked. I don't know. I'll check. Go through this and then do it. But I wanted to do PERDCO today. So PERDCO was a requirement. She wanted me to do PERDCO. I thought of doing a consolidated P&L. So I have two choices. I can do it now, or if you think it's too much, I can do it tomorrow. If I finish it today with that, I'm done. Actually, I can finish it off. And what basically is happening is 14th. Today is 14th. Yeah, I'll finish it off today so that it's easy for me. Because tomorrow I have a flight to catch, so basically I'll finish it off. So it's easier. But I'll give you a short break before we are done. I'll give you a quick 10 minutes break, and then we'll start at 12 o'clock. Let's start at 12 o'clock. Okay. So basically here under this also there are two questions, which is Huston, which is a ratio analysis question, and then we also have Fancy. So two questions. Okay. What I'm going to do is I'm going to give these two for you to do it as your mock exam, and then I will discuss it with you to understand where your weak areas are. So basically, these two questions I'll be discussing with you on Sunday. This Sunday we are going to discuss these two questions. Okay, online, 100% online. This Sunday it will be 100% online, where we will be discussing these two areas together. But there was a requirement for me to do PERTCO question, that we will take a short break and do PERTCO. Okay, super.
இந்த சாமோட ரேஷியோ
But I'm only the question and until you go through this. Morning finance accounting paper everybody
ஈஸியா தான் இருக்கும் ஒண்ணுமே இருக்காது 11th 12th தான் 11th
இந்த மாதிரி ப்ராப்ளம்
அதான் ஒண்ணு நான் சொல்ல செக்ஷன் சி அட்டெண்ட் பண்ணுறேன் செக்ஷன் சி அட்டெண்ட் பண்ணேன் செக்ஷன் பி அட்டெண்ட் பண்ணேன் 1 hour 1 hour 15 minutes ஆகும் அப்போ செக்ஷன் ஏ பார்க்கணும் 30
MCQ கொஞ்சம்
1 mark
70 marks exam
35 இதுல 30 வாங்கணும்
தெரியல
டிஸ்கிரிப்டிவ்
டிஸ்கிரிப்ஷன்ல மட்டும் 30 வாங்கணும் அது ஏதோ அசஸ்மென்ட் பண்ணுவாங்க
அது அவ்வளவுதான் எதுக்கு யூனிவர்சிட்டி
எப்படி எக்ஸாம் நடக்குது அதுக்கு ஆடிட்ல இருந்து இந்த ஒரு சப்ஜெக்ட் மட்டும் போஸ்ட் பண்றேன்
தெரியும் என் தம்பி உங்களுக்கு தான் எழுதலாம்
சேம் இந்த நாள் பாலிச்சு
அப்படியே விட
சி
இன்டர்
மாதிரி இப்போ இன்டர் நீங்க ஃபவுண்டேஷன் சப்ஜெக்ட் வந்து So inter 3 times. 4 times. 4 times
ஃபர்ஸ்ட் டைம் வந்து சப்ஜெக்ட் கிளியர்
நீ வந்து
பாட்டினா
சொன்னீங்க
பாட்டினா 30
ஆமா சாசி all 3 இதுல வந்து அக்ரிகேட்
பாஸ் பர்சன்டேஜ் 12% வேணுட்டே ஃபெயில் பண்றாங்க நல்லா இருக்கும்
அவங்க பேரு ஃபோன்ல ஆடிட் ஃபோன்ல ஜாப் போறாங்க
போய் சேர்த்துக்கலாம் நம்ம இஸ்ரேல்
இது போட்டு
ஆனா அதுக்கு இன்னும் 2 இது இருக்குல்ல ஆடிட் எக்ஸ்பீரியன்ஸ் இருக்கு எப்படி சொல்றது
நம்ம ஆடிட் இன்டீரியர் இருக்கு பட் அவங்க சைட் பை சைட் பண்றாங்க எஸ்பிஆர் கிளாஸ்க்கு ஒரு திட்டிட்டு
என்ன பேசவே இல்லை
நானும் பேசுறேன் கிருத்திகா பண்றாங்க ஆல்சோ அவங்க இந்தியன் போஸ்ட் கொடுத்தாங்க ஸ்டார்டிங்ல போஸ்ட்
பிசிக்கல் ஜாயின் பண்றாங்க ஒர்க்ல எங்க
அவங்களே ஆடிட் பட் அவங்க ஹிந்தி மாதிரி ஜாப்
அந்த ஸ்கில் பண்ணிட்டாங்க
பட் நம்ம கேட்டிருந்தோம் உங்களோட எக்ஸம்ஷன் அவங்களுடைய சோர்ட்டில் வந்து 5 papers or 4 papers கம்ப்ளீட் ஆச்சு அவங்க கிட்ட பேசிஸ் ஒரு எக்ஸம்ஷன் நீங்கள் 9 papers முடிச்சுன்னு சொன்னீங்க இல்லை நான் எக்ஸம்ஷன் ட்ரெயின் பண்ணுறேன் இது பண்ணிடுறேன் ஆல்சோ அவங்களுக்கு டிகிரி இருக்கு எப்படி இருக்கு நான் கிட்ட எனக்கு பிரியங்கா அவங்க மட்டும் இப்போ எஸ்பிஆர் யாருமே எஸ்பிஆர்
இதுக்கெல்லாம் போலையா பிரித்திகா சாஷிகா
அவங்க பண்ணல அவங்க வந்து ஜனவரி
மார்ச்
என்னது
எஸ்பிஐ
பட் நந்திகா
ஹரி
அவங்க வந்து ஃபவுண்டேஷன் பண்ணிட்டு இருக்கேன்னு சொன்னா அன்னைக்கு டாக்ஸ் ப்ளஸ் ஒரு ஃபவுண்டேஷன் எக்ஸாம்ஸ் இருக்கு இவங்க ஓடி ப்ளஸ் பிடி எஃப்ஏ எம்ஏ வந்து
செகண்ட் இயர் வந்து அப்போ லைக் One paper in foundation so that he can write professional paper. Even Nandita had the conditional exemption directly. So she went and wrote BT. She didn't write law, MA and all. She just wrote BT. And then she wrote tax. Now she's doing professional.
Oh, so இப்போ நந்திதா பிரேக்கா வந்து இப்போ SBI
Priyan Harmon வந்து 5 exemption tax வச்சு
SBI
SBI
டிசம்பரா இப்போவா
இந்த வரைக்கும் தான் நினைக்கிறேன்.
Report.
அவங்களுக்கு யாரும் மேம்
23.
Okay, and I've got a request asking me to continue or help with ratio analysis and the adjustments in PERTCO to do it. So I will do that, no problem. That's fine. Okay. So what I'm going to do is I'm not going to do this question. In fact, I'm going to take you through this question. I'm going to take you through this question and you're going to do it. I'm going to correct it, mark it, and then on Sunday we are going to do this question in my approach. Okay. Well, like I always say, today is 14th. Yes, no problem. We have about 20 days. I will be with you until the last moment of the exams. So see, I promised that I'll come back. I'm here. Once again, I'm giving you a schedule on Sunday. We are meeting at least for about 5 to 6 hours this Sunday. Okay. I'll give you the exact timing. I'll be sharing it with the team by today, tomorrow. I'll be sharing it with the team. Super. So there you go. Going back to what we have in terms of Huston. Calculate the missing ratios. Okay. We will calculate the missing ratios and then write a report for the directors to assess the financial performance and position of H for the year ended 31st March 2015 compared to the previous year. Your answer should refer to the information above and the impact that Sparks has had during the year. Some person or an entity has had an impact. You should talk about that. Okay, so the missing ratios over here, they have given some ratios to calculate 2014 and 2015. So what we will be looking at is we will be first looking at how to do the ratios. So custom, there you go. What are the ratios we have? Let me make my life easier so I don't have to swap between here and there. I've got 2014 and 2015. So my ratios 2014 and then I also have 2000 I have 2014 and then I have 2015. Are we clear? Okay. My ratios are going to be ROCE, gross profit margin. In the exam, you can always copy paste, no problem. Net profit margin, but they say net profit before tax. So please make sure that you do it accordingly before tax. Correct? That's what your examiner wants from you. Current ratio, quick ratio, current ratio, quick ratio, inventory holding period, receivables collection period, payables payment period, and gearing, but gearing as a percentage of debt plus equity. So you're going to take debt plus equity. Given to you 2015 is 31% in terms of ROCE and current ratio is 1.3:1. That is given. But 2014 you have everything here: 37%, 28%, 14%, 1.1 is to 1, 1.1, 1.1 is to 1, and then 0.4 is to 1, 162 days, 69 days, 138 days, and 42%. Okay, there you go. We've got a lot of information. We've got about 2.5, 3 pages to read entirely. Okay, as you read, I want you to start getting your ratios answers like this in the exam. Remember, our analysis will be right here. Clear? Comments, performance, and position. Anything extra I want to say, I'll bring it here. Correct? Okay, now you can see I'm not changing anything that I have entirely taught you how to do. I'm exactly following my pattern.
All the questions we do this week. No, they are asked like a report. So we write.
Sorry?
They are asked like a report to the director. So we.
When they say write a report to the director, all what you're going to do is, okay, you're going to keep it very simple. Let's say if it's a report requirement, yes, for example, they say write a report to the board of directors, to board of directors, date today 14th of August 2025, subject report on performance and position of Huston, H by financial analysts. So if you want to make your report, I'm assuming this is a report, and then I'm here, but they don't want a report, do they? Yeah, write a report. Oh, I'm sorry. It's a report. Yeah. So if it's a report, this is how I do: to board, date, by subject. Once I'm done, dear sir, please find below comments on the performance and position of H undertaken by us. This report is solely for the purpose of management only. In other words, we don't take third party responsibility. Please let us know if you have any queries. Since it's a report, there you go. Kind regards, financial analysts. For this format, you actually get 2 marks in the exam. You can copy paste this format for any questions, no problem. I'm sure for students who are coming from audit background, this is not new. In audit, you have done your internal control deficiencies, internal control recommendation. We always do it. Write a report. We have written reports. So there you go. Copy paste, same format. And then you make your life easier, your comments and your position. Are we clear? Okay, I'm going to give you a good 5 to 10 minutes to go through this on your own. While you go through, I want you to start filling the blanks, your ratios. And then I'm going to give you some areas where you're going to start working on your answers. And then I want you to do the answers, send it across to me today, so I can correct it by tomorrow. If I send it today only, I'll correct it tomorrow. If not, I will not correct it. Everybody can send it. Whoever, YouTube students, anybody watching it can share it to me. I'll try as much as possible to correct it by tomorrow, so that when I do it on Sunday, I can give you your feedback. Okay? Super. You can start reading the question on your own. Done? Got your ratios done? Okay, calculate your ratios. Quickly calculate your ratios. So we're going to do it together.
The PhD.
Okay? Done? So you start doing the calculations. Okay, 2 more ratios. Okay, I'll give you time to calculate the 2 more ratios. Okay, done. Okay, let's get back. Let's get back to business. Okay, ROCE has fallen down. We know gross profit margin. Gross profit margin will be okay. Let's quickly read through the question. Right, superb. During the year ended 31st March 2014, H had been subject to much press interest concerning its poor performance, and as a result, its share price had fallen considerably. Okay, so our company H has been having a poor performance and the share price has fallen considerably. To remedy the situation, to help with the situation and help improve the share price and market confidence, H employed a consultancy firm, Sparks, a firm of strategic consultants, to recommend the best course of action to improve both its statement of profit or loss and statement of financial position. Like when we fail in marriage, we go to a counselor, counselor sits and helps us. A psychiatrist, we go, something like that. We've got a firm of strategic consultants who are going to help us with the best source of action, with the best course of action to help improve the performance and position. The board of H were quick to act on many of S's recommendation. Okay, after they got to know, okay, they were quick to act on what needs to be done, and are pleased with the effect that has had on the performance in the year to 31st March 2015. Okay, they say, okay, we've got some strategic consultants who came in. Once we listen to them, look, our profitability went up, our profits went up. So we are happy. I'm pleased, I'm happy with what the consultants solutions were. So now the requirement is, okay, hey, go write a report to the directors to assess the financial performance and position and also compare it with the previous year. When you do that, you should say if their recommendation was effective or not. What do you think at the outset? What do you think? Is it effective or not effective? 50-50. Okay, let's see why it's 50-50, or why it's effective or why it's not effective. Your revenue has come down, no improvements in revenue. However, your gross profit has gone up. Probably there has been a lot of cost controls. There have been a lot of cost controls. Distribution costs have gone up significantly. Admin expenses have almost tripled. Profit from operations have fallen. Profits from operations have fallen. However, it has been offset by selling a plant. You've sold a plant and then you've got your finance cost, but your finance cost is reducing from last year to this year. Therefore, your profit before tax is going to your profit before tax has dropped and your taxation has dropped significantly, which is increasing your profit for the year. So basically, if you ask me, there's no improvement here. Some slight improvements here. No improvements here. But there have been certain small adjustments, small items which has helped us to get a better profit than last year. So when you look at it at the outset, it looks good, but I cannot compare without having more information. That's why I have to go down. I look at my assets, and if I look at my assets, my PPE, I've disposed, they say, so my profit could have gone up because of that. My goodwill is the same. My development cost is not there anymore, meaning probably it is not qualified to become a development cost. The criteria are not met. Inventory has fallen significantly, meaning my cash position should improve. Yeah, it also shows here. My trade and other receivables have come down. My share capital is the same. My retained earnings have gone up. My convertible loan note, I've gone for a convertible loan note. I've gone for a loan note, but I had a loan, but I have entirely repaid my loan. My deferred tax, yes, have come down significantly. Could be the impact on my taxes. Provision for overhaul. Provision for overhaul. Okay, there's something called provision for overhaul. Provision for overhaul. Overhaul means what? Overall means repair cost. Overall means maintenance cost. Significant inspection cost. For example, if you take an airline industry, right? Every 25-30 years, you have to do a proper maintenance of your engine. That's your overall cost. So, overall cost in line with IAS 37 can be provided, cannot be provided. They cannot provide. So, this looks like there is a problem with the treatment for me. Trade and other payables have come down. Taxation have gone up. Bank overdraft has become nil, showing a better financial cash flow. During the current year, the development expenditure was written off to administrative expenses. Okay, so I had development expenses of 1,120. It was written off here. That explains the reason why my admin expense goes up. It is a one-off cost or it's not a one-off cost. It's a one-off cost, meaning my profit from operations, my operating profit is affected because of my development cost, which is one-off cost. So maybe I might not have it anymore. So I don't have operating profit margin. However, I have got net profit margin. So I have my development cost one-off, correct? One-off that I have. So this has improved my net profit margin or it has affected my net profit margin? It's affected. Okay. Having said that, we can also calculate our ratios. My GP margin, my gross profit over revenue, my gross profit over revenue, 3840 over 9600 equals 3840 over 9600 gives me 40%, which has improved. My net profit margin will be 1,240. No, I can't take 1,240. They want me to take 1,280. Correct. So 1,280 equals 1,280 divided by 9,600, which gives me 13.3%. Also explains why there is a slight drop. Correct. Okay, we have got the development cost one-off, which has had an impact on our this thing. Quick ratio. Anybody who calculated quick ratio? Any answers? How is your quick ratio? How did you calculate it? Please tell me. current assets minus inventories. Okay, how much is my current assets? I'll go down. My current assets is 5080 minus
1,400.
oh, I'm sorry 3400 minus 1800, correct, equals 3400 minus 1800 over current liability is 2520 over 2520 over 2520, 0.63 is to 1. So meaning it's slightly improving. My inventory holding days, okay, my inventory is
1,800.
1800 over cost of sales 5760, so equals 1800 over 5760 into 365 days. Improved, significantly improved. My receivables collection period, is trade receivables 760 equals 760 over sales is given at 9600 into 365 over 9600 into 365, 28 days, which is significantly improved. Payable period, my trade payables over cost of sales, my trade payables will be 1680 equals 1680 over 5760 into 365, 106 days. Gearing, debt plus debt over debt plus equity. Okay, my debt, my long term debt is how much, my dear?
1,600.
You have to take only 1600. Okay, you can't take deferred tax. 1600, so 1600 over equals 1600 over open bracket 1600 plus my equity gives me,
344.
my equity is 3440. There you go, my ratios are calculated 32%. Okay, my development cost written off will have an impact on my net profit margin, so I have a point to talk about. Okay, superb. Now let's go further. In addition, following on from one of the recommendation of Parks, Huston Co. is outsourcing the manufacturing of one of its products. So you're outsourcing one of your products. This has enabled the company to dispose of some surplus plant. This plant had been due for an overhaul in 2015. Okay, now what is happening there? What is happening there? Well, you are outsourcing. You're making an outsourcing decision. If you outsource, your direct cost is going to come down or not? It's going to come down. Why? How come? Your direct cost will come down. Your cost of sales will fall down. That explains here why your cost of sales is going down. So meaning when you're doing it in-house, probably your cost is high because you outsourced. For example, if you've studied audit, probably your internal audit function can be had in-house or it can be outsourced, where you can primarily focus on your business activity. Internal audit function is not something that you need at all within your company. You can outsource it. If you outsource it, you have a lot of cost savings. Generally, outsourcing not your primary product. Now we can't outsource teaching. Maybe we can outsource photocopying. You understand? So I don't need to have a separate person doing outsourcing. I don't need to have machinery cost. I don't have a space for outsourcing. So all those I can cover. So with outsourcing, I can save some direct costs. So that also explains that they have saved some cost here. So my GP margin to increase, go up. Outsourcing could have resulted in direct cost reducing. Are we clear? Are we clear? Plus, what did you do? You also disposed some of the surplus plant. Because you disposed some of the surplus plant, you obviously had some, it has affected your profits, net profits favorably. Correct? So your net profit margin, your profit margin, for it to go up, one of the reasons is disposal gain. Disposal gain. Positive impact on profits. But my problem is, my question is, okay, is that going to continue with you? Disposal gain this year you had, next year will you have? No. So meaning you can't expect it to be a consistent way of profit increase. Having said that, there could be another reason why your cost of sales could have gone down. Why? You disposed your assets. Because you disposed your assets, depreciation is not there anymore. Because you do not have any depreciation, your cost of sales could have gone down. That is my third point. So due to disposal, depreciation is not provided. So that could also have an impact in my gross profit margin. Are we clear? Yes or no? Are we clear? Now, for my gross profit margin to go up, my revenue should go up, or my cost should go down. Here the problem is, yes, there is a reduction in cost. Yes, I'm not saying no. But, you know, your depreciation, those areas are coming off. But your revenue is dropping. Isn't it worrying for you as a company? It is worrying. So you can obviously go and say, hey, look, our revenue is dropping. So although there is a growth in GP margin, revenue is dropping, which is worrying. What is the revenue drop percentage? Revenue is dropping 10,000 minus 9,600 as a percentage of 10,000. You can show a decline in revenue percentage loss. Are we clear? Are we clear? So in the exam, where am I? How many marks do I need? I need 13 marks. I'm getting about 2 marks here. My conclusion, I'm getting about 1 or 2 marks, 4 marks. Here, 1, 2, 3, 7 marks, 8, 9. I've got about 9 marks. I need about 5 to 6 points to get my 15 marks in the exam. Sorry, 13 marks in the exam. You understand? You understand my point? So it's about strategically planting your answer. You have to be strategically planting your answer. In other words, planting and planning. Let's go further. Okay, other problem. Plant overall. So overall cost, the treatment itself is wrong. The overall cost, your treatment itself is wrong. Are we clear? HCO had been accruing a provision for overall cost over a 4-year period. Over a 4-year period, you have been showing what? An overall overhaul cost. Overhaul cost means what? Overall cost means repair cost. Your repair cost. Okay. Just a moment, guys. Okay. Your overall cost is your maintenance, repair cost is your bigger cost. Now they have given you overall cost for how much? They say the overall cost is 1480. So it is a major cost. What is happening? They say H had been accruing provision for overall cost for over a 4-year period. In line with IAS 37, you can't do that. But due to the disposal, this was no longer required and the provision was released to cost of sales. So meaning all these years you have been carrying an overall cost of how much? 1000. Overall cost of how much? 1000. Sorry, 1480. 1480 was there, but this year you just removed it. Correct? Because you're disposing the asset. But technically you can't provide that in the first place. That itself is wrong. Okay. But when you compare it this year, your 5760, if you have to do a proper comparison, should include this 1480. Correct? So technically, has your cost of sales fallen? No, it's not fallen. So it's not fallen. The treatment is incorrect. So your GP margin is wrong. Basically, last year's GP margin cannot have 1480. It should be 7200 minus 1480. Take your calculators. 7200 over 1000 minus 4480 gives you 5700. 10,000 minus 5700, your GP will be your gross profit will be 4280 as a percentage of 10,000. It's about 42%. Correct? As a percentage of 10,000 is about 42%. Okay, so if you had released it, that is, the treatment is wrong. If that is not there, this would have actually been 42%. Meaning your GP margin is also falling. So my next point could be here. Overall cost treatment is incorrect. Therefore, last year's GP margin would have been how much? 42.5%, whatever. As such, in reality, GP margin has fallen. You understand my point? It has fallen. No, these are not my answers. I'm giving you points, okay? Now, in the sense, if you can't develop this and write an answer, I do not know, I have to come and do the answer. That's the only thing that I have which is left. I'm giving you the points, but at least develop this and make a structure, because I want to see how you're working a structure out. Are we clear? Understood? Okay, let's go further. Well, GP margin, we are entirely done, I feel. And then net profit margin. Net profit margin, we spoke about development cost one-off, disposal gain impact. But I'm also a bit surprised why your distribution costs have gone up. Why do you think your distribution costs could have gone up? Because of outsourcing. Okay, because of outsourcing. Your outsourcing could have resulted in distribution cost increase. Therefore, yes, overall net profit margin is okay, but still I feel there is a bit of a problem. Having said that, we don't understand this entirely, so we need more information. So more information. Now remember, I spoke to you. More information. Detailed cost breakdown of distribution cost and admin cost, AC and DC. It's a part of my conclusion. See how I'm connecting. I'm connecting my scenarios. I'm telling the examiner, look, my points, give me my marks. Are we clear? Super. Okay. My ROCE, my primary ratio. What is happening to my ROCE? My ROCE has come down. Okay, why would ROCE come down? My ROCE would come down if my operating profit is affected. Then there you go, my profit from operations have come down. So obviously one reason why my ROCE is falling is due to operating profits falling. Am I clear? Right, my operating profit is falling, correct, but what is happening to my capital employed? What is happening to my capital employed? Did you check what is happening to my capital employed? Because I think they have given us directly the answer. We did not even bother looking at capital employed. Correct? Okay, now tell me what is happening to capital employed. Compare the capital employed from this year to last year. My capital employed, how do you calculate? Okay, tell me the capital employed figure. How much? What's the impact? Capital employed, how do you do it? Sorry? Okay, how much are you getting? Yeah, total assets minus? Okay, total assets. How much are your total assets? Okay, it's last year and this year. Last year 12,000, this year 8,000.
Because of the cash.
Because of the?
Bank.
Okay, let's calculate it. 12,000 minus my current liabilities, is it? Okay, so 12,000 minus 4,520 gives you how much? And 8,000 minus 2,520. 7,480 and 5,480. Okay, so meaning my capital employed is also going down. My capital employed is going down. My profit is also going down. But overall, if capital employed goes down, basically what has to happen? My ROCE should go up. Correct. If capital employed goes up, my ROCE will fall. If capital employed goes down, my ROCE has to go up, but ROCE is coming down, meaning my profit is falling at a higher percentage than my capital employed. So ROCE is falling due to operating profit falling and capital employed falling. Technically, the fall from capital employed is higher compared to operating profit fall as a percentage, if you see. That's why my ROCE is falling down. Yeah, sorry. Technically, the fall of CE, capital employed, is higher than, because capital employed is falling more than my operating profit fall. So that could obviously result in my ROCE going down. You understand my point? But my capital employed is falling down, right? Why? Because there are impacts in my reduction in liabilities. My liabilities are reducing. So my capital employed to go down, there could be even further, I can talk about reduction in liabilities, my liabilities is being reduced. Number 2, I have got overall provision which is being reduced, which is being offset. Overall provisions are also having an impact. And if you actually look at the scenario, your deferred tax is coming down significantly. That will also have an impact in my capital employed. So my deferred tax, overall provision and deferred tax impact. You can speak about all this. Are we clear? Are we clear? So how many points in the exam? 1, 2, 3, 4, 5, 6, 7, 8, 9. 9. I get 1 mark, let's say 10. Here 1, 11. Right? For my ratios, how many marks? 7 marks. 11 plus 7, 18. I've got to give 2 more points. I'm giving you these 2 more points to work on here, and everything here below, I want you to do it on your own. Draft a nice answer, send it across to me. I will review it, I will mark it if you send it to me today. And if you are going to send it to me, the easiest way to send it to me is my email, zian@ppim.edu.lk. I want you to directly send it to this, and then I will mark this. When sending, in your script itself, your name should be there. Only then I'll mark it. If not, I can't mark it. It's very difficult because I get a lot of scripts. So your name is John, means in the script, what you're putting on your Excel sheet, mention your name as John FR Chennai. Chennai if you're from Chennai. Chennai if you're from any parts of the world, anywhere, or in India, just mention where you are from. So it's easier for me to categorize you and respond to you. Very well. With that said and done, I am leaving you the last part of it for you to do, and I will be meeting you on Sunday. Sunday we are meeting at Sunday we are meeting at 17th of August. We are meeting at 11 a.m. 11 a.m. 100% online. 11 a.m. 100% online until 2 p.m. 11 to 2 we are going to entirely do the question, this question, and then I have per question to do it. In between, if you want me to do any other questions, I want you to send an email to me. I will be doing that questions. I'm prioritizing if there's anything that you want me to do. Apart from that, we will be also meeting the following Saturday 1:30 to 5:30 p.m. The following Sunday 1:30 to 5:30 p.m. So this Sunday we are meeting at 11 to 2. Following Saturday and Sunday 1:30 to 5:30 p.m. we'll be meeting, and the following Sunday will be my last class with you officially. Technically, physically, this is my last class with you. With today, I'm done. Physical sessions, I'm done. So tomorrow we are not meeting because I've covered this. Again, I'm meeting you on Sunday. Sunday 11 a.m. I'm meeting you until 2 p.m. You can send me if there are any doubts across to me. I will work around it. Apart from that, next Saturday we are meeting at 1:30 to 5:30. The following Sunday we are meeting from 1:30 to 5:30. This is the plan. Thank you so much for being a part of the marathon session. I hope everything went well and smooth. And this is my physical session I'll be conducting online. Plus, I'm recording the mock, the pre-mock which is released. I'll be recording the mock and the team will share it with you. So mock recording, and I have done about 4 to 5 past papers under exam timing. Under exam timing, 4 to 5 past papers is done. That will also come to you on screen. And with that, we conclude the session, and I'll see you on Sunday at 11 a.m. Bye-bye.